Exciting, but I bring you numbers. Here they are. Let's start off and see exactly what is happening with the FTSE. Flat as a pancake. Yep, this is exciting stuff so far. We are going to move on maybe to some of the other markets that may move a little bit more, but I very much doubt it. Is there any news that can stop the CAC and the DAX opening a little earlier than normal? I can't see it this morning, but you never know. In some ways, I'm actually praying for it, because actually some exciting news out of one of those two markets would certainly liven things up a little bit. But no, they do not open. Oh, there they go. And it's an exciting open. The CAC is up by 0.2%, the DAX is up by 0.1%. This is blistering stuff being generated by European equity markets this morning. We are, though, as I say, going into a long weekend, so maybe this is slightly understandable. Critty, what are you seeing on the sector story? Anything there?
The sarcasm is really fun this morning. I'll start off with maybe some of the individuals that are actually, I think, moving this market, because it's a little bit of a mixed picture here. I'm looking at 358 stocks in the green, about 160 in the red, and it's not really moving the market much, to your point. But when you look at it from a kind of index perspective, you are starting to see the likes of technology, healthcare, even utility. Some of the more defensive sectors are in the green. Some of the more perhaps cyclical and risky sectors in the red. From an individual stock story, though, I think it's interesting. Deutsche Bank, I've just been flagged as an ex-div this morning. It's actually weighing on the stock 600 the most, down about 1.8%, but again, in the context of that ex-div story as well. But to the upside, I'm seeing some of the tech names, some of the healthcare names. A lot of the names sold off yesterday are in the green today.
Balance is actually quite positive. So I've got 185, 190 up, I got 122 down. So the market does feel broadly more positive this morning than negative. But in terms of where the points are being added and taken off, as you say, some of the ex-divs out of Germany are probably the biggest factor. On a day when ex-divs are the story that you focus on, it probably tells you that actually there's not much else going on either. Novo's a little more positive this morning. Actually, some of the pharma stocks are doing better. So that probably is where the action is. So Novo, Astra, I'm seeing Roche on the screen as well, doing relatively well. Some of the luxury stocks are coming back a little bit. But there's no clearly kind of obvious discernible story that is emanating from this from a sector point of view or a single stock point of view. Novo and Astra doing the heavy lifting in terms of the biggest percentage gains. You've got Thule, Bridgepoint, Iveco and CVC on the upside. Not big moves.
Not big moves. I'll just point to the one on the screen here. You mentioned some of the pharma names. Bayer as well is getting a bid, and I believe our producer this morning had actually flagged this to us for a couple of reasons. There's a report that had Bayer in the footnotes as well coming out of the state, but I'm also seeing headlines this morning out of Dow Jones saying the European Commission decision around some of its drugs that are due for review and potential extensions are also perhaps due for approval. So perhaps a little bit of a double whammy in terms of Bayer. Certainly seeing some heavy volume this morning. Let's get a little bit more perspective on perhaps these broader markets as we struggle to come up with a single stock story. Christian Muller-Glussman, head of asset allocation research over at Goldman Sachs, joins the program mostly to rescue us, but also for his analysis. Walk us through kind of, I'm asking every guest this, what's the next catalyst here? As we're kind of in this holding pattern, what do we look to next?
Yeah, I mean, listen, I think we've been in this fast and furious, sentiment-driven, uncertainty-driven market where the market went from being a bit bullish coming into the year to this extreme bearishness. And I think now we go into data period, and I think we're all seeing that hard-soft data gap, which is still in the data, the biggest since the 70s. So the expectation to some extent is that the hard data will start to crumble. We're waiting for that. We're not seeing it. We are expecting it. And that to some extent gets markets probably then to focus a bit more on the impacts. Is it going to be the consumer? Is it going to be the labor market? Is it going to be selective corporates maybe? But I think we're not going to get much until, probably June, July, where this impact will be felt. So the other thing, the market always can focus focus on one thing at a time. The other thing the market is very focused on is the bond market. And this idea that you've had the kind of budget bill pass and fiscal concerns are coming back a bit. But it seems that this has moved quite a bit already.
You know what's so interesting is Guy was touting himself as the British, having a British accent and bearish.
You sound
right?
cleverer, basically, if you have a British accent and you're a bear. That was the argument that was put to me earlier on this week. I built an entire career around that strategy, so...
I'm not debating it.
I won't say anything.
Yeah, I'm not debating it, but the reason I bring it up is because I feel like sometimes I have a bullish bias as well. And when you're looking at the deficit story, or at least the tax bill story, some of that has been the concerns around the fact that the deficit will widen, therefore the bond market is freaking out. But the tax bill also includes tax credit extensions. To what extent does that cushion a consumer, an American consumer, and that resilience story that perhaps was in question 2 weeks ago?
Yeah, I mean, I think we're all hoping for that. And there's a certain endogenous element. The equity market will be most important for the consumer because of the wealth effects and the household allocations to equities. So to some extent, if the equity market holds up, that might be even more important than the budget bill. But I would say that the net effect of the tariffs relative to the budget bill, we actually think the net effect is negative. So our economists have done a lot of work on it. So if the tariff rate, the average tariff rate stays at 13, we still think that there's going to be a growth drag. But I think you're right, that's the plan. That's why they pushed it so quickly. I think they want to get that bill in to kind of counterbalance the negative effects and set them up nicely for the midterms.
I mean, I want to sort of maybe return a little bit to the bearish argument here. If we are seeing, if we are seeing these drawdown risks normalize, and we're seeing some of the rally risks also normalize since that April Liberation Day, do you think markets are underpricing some kind of macro shock in the second half of the year? I know you've highlighted we're waiting for this hard data to come through.
I think so. I think definitely it's not going to be an easy end of the year. I think the baseline we have is probably a bit like a fat and flat range. I think the growth might drive occasional setbacks. If you don't see those setbacks, the bond market will create a speed limit for equities. So you're a bit more range bound. So you're back to that growth rates tango. We've seen it before, like back and forth between growth and rates. And I think you're right, there's like downside tails. I think they come in particular from the labor market. The market is very nervous about any deterioration in the labor market. They come from profitability, like corporate profitability has been a key driver behind the elevated US equity valuations. So if you see any signs of that changing, I think it will scare investors. Like you heard, obviously, the headlines with Walmart having to absorb the tariffs, etc. I think all of those things will be very closely watched. So you still have that risk. But what we are saying is the volatility reset we've seen is one of the fastest on record. So at this point, rather than market timing aggressively, we would recommend maybe hedging, diversifying selectively, and waiting for the data to give us a more clear direction.
Okay, so on that sense, perhaps, of a false sense of security that is created by this very fast reset, where do you think investors should be looking for then? And then that question of that sort of diversification, that hedging, where do we go in this environment?
Yeah. I mean, I think most important, the biggest risk in your portfolio is probably equity still. So I think most of our hedges, most of our risk mitigation strategies are very focused on equities currently. We've looked at low volatility stocks, revisiting them maybe as they fall behind. We're looking at selective overlay hedges via options. So I think that's the first port of call. We've also seen quite a bit of interest on rates hedges, where people are worried about the 10-year breaking the 5%, and then the feedback loop go to the whole portfolio. It will hit equities, it will hit fixed income. And in terms of diversification, I think there's a lot of focus on gold because it has a really weird characteristic of protecting you, obviously, from broad risk on, risk off possibly, but also having this fiscal and this debasement characteristic. And we still know that investors are not happy with their dollar allocations, with their dollar assets. So I think any opportunity to diversify that and reduce that is interesting. So we even had people recently look at emerging markets assets as a diversifier for their dollar exposure, trying to go up in quality in EM local currency debt, which is somewhat defensive, but then get a bit of a benefit in case the dollar weakens.
I mean, you talk about this sort of move away from dollar assets. It's something that we're really familiar with in Asia. It's a real paradigm shift. There's a lot of soul searching going on. But it's also been very painful, these very painful dislocations, what we've seen with the Taiwanese insurers, the Taiwan dollar, that movement in the yuan. So I want to ask about those pockets of risk that you see as we see that move away. How do you think about the contagion effects, for example? How orderly is that unwind going to be?
I don't know. I always feel like when you think about the rebalancing of U.S. assets in global portfolios, it could happen in three ways. Like equities could sell off a lot, bonds could sell off a lot, or the dollar comes down. I actually think the weaker dollar is the least bad. I think for portfolios and for the U.S. consumer and probably for the global economy, to some extent the strong dollar has actually tightened global financial conditions and has arguably been a bit of a cost for the rest of the world. So the weaker dollar is the path of least resistance. It's a quite easy way to rebalance these imbalances. It can be disorderly occasionally if the market gets worried about policy initiatives, if the market starts to see a more stagflationary impact of the tariffs in the US compared to the rest of the world. That could really change things. Obviously, the market is still very focused on monetary policy independence. I think we had that Supreme Court ruling yesterday, which kind of makes firing less likely, but we still will get a new Fed chair. And that new Fed chair will be scrutinized very closely in terms of understanding monetary policy independence, and that matters a lot for the dollar.
What's the pain trade right now? What's the market kind of going to hate? Is it equity selling off, which I think a lot of Americans will be upset about, or is it actually American assets, US equities, melting up at this point? I'm kind of wondering what is it that would cause the surprise, the pain trade? What would the market hate right now?
I would say, I think you said it nicely. I think you always go back to what's happened recently. You had S&P down, Treasury down, dollar down being the major concern. So investors try to address that in their portfolio. Yeah. So if you now see the opposite, S&P up, Treasuries up, dollar strong, like a complete reversal, let's say, the tariff rate really has another major leg down and you see a big squeeze. I think that would probably be the pain trade. But just to be clear, it would be painful for the tactical community, but strategically all long U.S. assets. Yeah. So from that perspective, it wouldn't be as painful maybe for a lot of the institutions. And I can tell you, while this U.S. dollar and U.S. asset reallocation is somewhat ongoing, it's early. I think a lot of the clients we speak to, they have done things at the edges.
Okay, well, let's follow up on that. How convinced should we be by the make Europe great again argument? Because everybody's talking about reallocating to Europe, or some people are talking about reallocating to Europe. As you say, maybe we're still early in that process. But there's still this kind of nervousness at the back of everybody's brains that we've been told that Europe's great before, and it turned out to not be great. And I'm wondering how much of an impediment that thought process still is in terms of people's thinking.
Yeah, I think there's two narratives here, two motivations. One of them is home buyers. So what we've actually seen is the Europeans have been among the strongest buyers of European equities and sellers of US equities. Right. So you just go back home. Yeah. And that can make sense even from a currency perspective because you are managing money for people in euro. You're matching liabilities in euro. And I think that is a very sensible thing to do. Often that's less driven by the fundamentals where people are arguing that it's more about risk management. And it's a true point that just European equities and US equities being less correlated argues, assuming the same risk, for a bit of allocation to Europe, even if there's a bit less return in Europe. Like this, the fallacy that Europe needs to outperform in order to justify allocations to European equities. But there's another thing. What we are currently discussing a lot from a fundamental point of view with clients is you need to look beyond sectors, companies, you need to look at factors. There's a lot of interesting factor-type investment strategies that you
Examples?
Sorry?
Examples?
Low volatility is the easiest. The simple low volatility strategy just ranks the stocks by their realized volatility and buys the least volatile. Okay. And we actually found it's a very interesting diversifier when you're late cycle, when you have volatility, and Europe has plenty of that.
You're the second person to come on the program today and talk about min-vol strategies, and that's quite interesting. Christian, thanks very much indeed. Nice to see you as ever. Christian Müller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Core 6 looks like this. Not expecting a lot of excitement here, but let's take a look anyway. There you go. Actually, there's a bit of movement. So certainly we are seeing some movement into the pharma sector this morning. Novo Nordisk on the left-hand side of your screen, certainly popping quite nicely after what has been a tough time, quite a volatile time for that stock. Let's figure out what else is happening. Let's turn to the finance sector. Joe Easton's here with the details.
So we have got some excitement, guys, some rare excitement this morning, as you say, but over at AJ Bell, we're seeing that one around 7% at the moment on the London-listed investment company, the retail investment firm, saying it did see a pickup in people buying stocks and shares during the volatility, given all of the sell-off and the ups and downs that we saw following the tariff news back in April, and therefore beating expectations on their revenue. Also the ISA impact, people trying to get their tax benefits in time for the tax year, probably helped with that one. Then we got Frontline. This is oil tankers over in Norway. Looked a little bit light on the net income, as we've got on the bottom of the screen there. Also the tanker rates coming down a lot, given the decline in oil prices, and also some of the shipping rates generally coming down a little bit weak on that one. Then Games Workshop, which is of course tabletop elves and goblins, one that probably doesn't get enough attention, but that one is down. A rare miss for that stock. That stock has rallied so much over the past few years, up around 500% or something like that, and the revenue today actually missing a little bit on some of the high ends of expectations. The Games Workshop recently added to the FTSE 100 as well, but coming down today. Then Hexagon on that M&A scoop from the deals team, saying that the firm looking to sell off their simulation software business, potentially worth a couple of $1 billion according to the report on that one. So a bit of a boost over in Sweden. Remember, that is worth around 30 billion, that company, in terms of market cap. Not a small firm, so worth some focus. Then in terms of tyres, Jefferies upgrading Michelin, as we said earlier, downgrading Continental. Specialist tyres in agriculture and in the aviation space is where the big tyre money is going at the moment, according to Jefferies. So they like that one. I did see Continental slipping as well. And then finally, another broker move, CVC Capital over in Amsterdam. That one gets a buy at Bank of America, which says that concern around private equity exit rates, so not enough private equity deal sales coming through, that is actually overdone now, according to them. So they reckon you should buy CVC Capital today, rising 1.5% in a pretty quiet market over in Amsterdam this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much. He ended there on the private equity story. We're going to continue to bring that conversation to you, this time with the founder and chairperson of European private equity giant EQT. Details of what to come from the Swedish firm, from the Swedish billionaire himself. Next, this is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating along the way.
This is Bloomberg Surveillance.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
There's been a big question of American exceptionalism and whether or not that era is over. Well, it turns out the chairman of EQT, the largest private equity firm in Europe, and of course a Swedish billionaire as well, believes that might just be the case. In fact, it's helping him make more progress in the PE space, not only here in Europe, but also in Asia as well. Let's get the take directly from him in this exclusive interview with none other than Connie Johnson. Take a listen.
It has been rather favorable for us not being based in the US and being a US firm. Because the ones we're competing with is almost exclusively the US firms right now. And they are having some headwinds out in the world for reasons caused by others than themselves. And the flip side of that is that people are looking more for managers that are not based in the US and maybe to deploy money with GPs that is not US based or US dollar denominated. So it has benefited us, especially in Asia, but I would say also in Europe to some extent.
What do you say to global investors that are looking to invest in Europe, or saying, give me a reason, Connie, give me a reason that Europe will suddenly wake up and catch up to the rest of the world? Is there a reason to be optimistic here?
Well, Europe would never have been able to get organized without getting pressure from somewhere. And now we got pressure from the US, and now we are trying to get organized. So it's clearly so that the understanding of the necessity of change is there. Now we are waiting to see the actions. We see some signs, but there are so many things that needs to change to get Europe back to a position of competitiveness. It's talked about, and everybody travels around, meets and discusses these kinds of things. But it has to be proven that we also can get into action and create the right regimes, regulations, allowance to consolidation. We need to have one common capital market. We need to have a handful of strong, big, successful European banks. Basically, we have maybe one today in Europe. And those things need to be put in place, and they need to be put in place by the politicians, unfortunately. And that's, of course, it's a bit scary, but we are hopeful that we'll get there. And we're helping them. We are participating in the dialogue around that.
What is the thing that no one's talking about right now? What are we missing? Because we covered a lot.
Yeah, I think this democratization of private equity is an area of concern of mine, because it needs to be done in a very mature and responsible manner, and because it's also so public. You cannot hide anywhere. I think that's one thing. I think the other thing is probably that I'm very skeptical. We have been discussing to do investing in credit, to setting up a credit business. I'm very skeptical towards that, because it's not investing, that's sort of lending money. And that's a completely different business than what we are in. And it's also unregulated. So we have a big gray banking market here. Everybody was pointing at the dangerous gray market in China for many years. Now we have our own gray market here. And that could also lead to mishappenings that will have a negative impact on, not only on us, but also the financial sector and the societies in general. And there the regulators and the politicians are too slow. They are not agile enough, securing that these things doesn't happen. Here I think it's too much greed too fast, and there's too much money at stake for people to exploit it.
Connie Johnson there, the founder and chairman of EQT. He's got his Jamie Dimon hat on, which I think is fascinating. He's kind of talking about this era of U.S. exceptionalism being over. He's saying it's helping them in Europe, but really he's got his eye on Asia. He's saying that's where the growth prospect is in the private markets. He's also completely throwing cold water on the private credit move. The hottest part in the private markets right now, he's saying it's looking a little sketchy. It's looking like a little bit of a gray area, making the comparison to Asia there as well.
I definitely want a Jamie Dimon hat. That's something that I would like a lot. We can get those made.
You bear a resemblance, I think.
I'm not really sure that's true, if only. Let's turn to other things going on in banking and figure out what is happening this morning. The EU confirming that it will delay bank trading rules by 1 year. This is another delay that we are seeing in terms of bank trading rules. Basically, the Europeans don't want to go before the Americans. Bloomberg's Tom Metcalf joining us around the table this morning. Is that too simplistic of you?
No, I like simplistic. No, and I think it's, broadly speaking, that. You see it in the UK and the EU. So this announcement, effectively confirmation, they delayed it by a year once. They're now delaying it to January 2027.
Yep.
And the idea is they don't want the Deutsche Banks, the BNP Paribas going up with a sort of one hand tied behind their back if they're implementing these stricter capital rules when, the US banks, no one yet really clear what might happen over that side of the Atlantic.
Can we talk about one of the biggest deals that we're keeping an eye on? That's like kind of a green light, red light situation, and that is UniCredit. Walk us through the latest with their Banco BPM bid.
Yeah, the battle lines, I guess, were already drawn, but today they came very, very clear. So you had a UniCredit statement effectively coming out there and saying, A, the deal's on pause for 30 days, and what they're using to do that is effectively to take the Italian government to court to see about these conditions that, Rome have imposed on them completing this deal for BPM. Look, there's that happening. At the same time, they say they're going to engage with the EU on a review of this sort of golden rule that Rome has. And then at the same time, this was actually yesterday, but BPM have come out and effectively kind of slammed how UniCredit's acting and this whole 30-day delay, saying it's just unacceptable and the deal should be pulled.
Is there a path forward here? And what is that?
The interesting thing from today, I think, is that UniCredit, aren't backing away. They're saying, look, we're trying to engage. We want to find a way forward. They clearly do want to do the deal if it's possible. But when you read the statement, the language is pretty fiery, and they go through and talk about this anima bid that BPM have done and effectively say we disagree with the way they sort of disclosed all that. So I wouldn't say it's sort of happy families at the moment.
All right, Bloomberg's Tom Metcalf walking us through some of the banking dynamics in Europe. We thank you so much. From, of course, UniCredit to what's going on in the EU as well. Coming up on the program, we're going to take the pulse from businesses adapting to a new trade reality. HSBC's Vivek Ramachandran joins us next. He's going to walk us through those U.S.-China tensions. Does the shipping data still actually matter? How do you trade these geopolitical pressures, and how much of that pricing power can you actually pass on? I feel like those are the questions that are roaming in everyone's head. Yep. Maybe he'll give us some answers as well. In the meantime, light volume, light liquidity, going into a long weekend in the UK and the US, but yet the equity indices are in the green. Stick with us. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again. Time and time again. And 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 time and time again.
region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome back to the opening trade. We're 30 minutes into today's session, seeing green on the screen across the board. Some extra oomph, I think we're going to call it, in the DAX, higher by about 0.5%. A lot of that has to do with Deutsche Bank, though. Or actually, in contrast to Deutsche Bank, though, that is, of course, one of your biggest downside movers. It is an ex-dividend stock, but one you want to keep an eye on as well. Light volume, light liquidity seems to be the name of the game. Of course, as we wait for that next catalyst, one of them being the geopolitics and the trade policy emanating out of Washington, D.C. It's that topic that's been a major theme at the Qatar Economic Forum in Doha. Take a listen to what some of the guests had to say about those challenges.
Consumers are starting to pull back on their spending, and business owners are starting to push off capital expenditures.
We just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates.
You have a substantial amount of uncertainty in almost every market.
The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment.
I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing.
And so you're getting back to, okay, this is a storm, but we'll get through the storm.
People used to be very U.S. exceptionalist, U.S. And we have seen some shift from U.S. to other countries since the beginning of the year.
I think we should all be very careful. There is too much debt in the system.
We have seen a de-escalation, but we still know that some tariffs need to be negotiated, that we're in a period of pause.
Some of the great guests we've been speaking to at the Qatar Economic Forum in Doha this week, talking about the impact of President Trump's tariffs. Where are we in that story? Well, let's explore it a little bit. ECB President Christine Lagarde warning overnight that international trade will, quote, never be the same again. This was obviously an interview on the sidelines of the G7 finance ministers meeting, which is taking place in Banff, Canada. It comes as HSBC publishes its 2025 Global Trade Pulse survey, which says that over 3/4 of corporates are rethinking their long-term business model as a result of tariffs instability. Joining us now, Vivek Ramachandran, Head of Global Trade Solutions at HSBC. So given what your survey is saying, Christine Lagarde is right. Trade will never be the same again. There is a big rethink going on. Is that the right way of thinking about this? And how long does that take?
I think trade has changed already. 65% of clients we've spoken to are already seeing costs go up. So that's happening today. And 1/3 of them are dealing with supply chain challenges and logistical bottlenecks. That said, no one expects the world to go back to where it's going to be. So everyone we've spoken to is planning to reshape their supply chains, look at new markets, or change their business model. Now, trade doesn't change overnight. No. Supply chains are built up over decades. They've been built up to minimize costs, and you can argue they've done that incredibly effectively. Now they need to become resilient, and they need to actually be able to move based on geopolitical concerns. And that's a big concern for companies.
So you're saying you're already seeing effects. How far into this process, though, are we? We're trying to work out when we see the effects of the tariffs, kind of how long does this process start to take to unfold and have a meaningful impact into the data? What guidance can you give us there?
You'll see it today in prices.
Right.
So 65% companies feeling an increase in price, you either pass it on to the consumer, you pass it on to your supplier, or eats it to
we saw it in the PMI data.
So we're seeing that today. But most companies are in wait and watch. you would not make a strategic move till you know where the tariffs are going to settle. So while you're hoping for a quick resolution, most companies are preparing for prolonged uncertainty. So I think we won't see fundamental strategic changes for another quarter or two till we see a resolution of where the trade boundaries are set.
Vivek, picking up on that point about passing through those costs, is it too early to get a glance into how that's happening, how companies are divvying that up between the consumers versus taking it on themselves? Is there a lesson to be learned yet?
It depends on the sectors. So sectors with a short production cycle, like tech, consumer healthcare, we're seeing that today. Sectors with longer production cycles, like energy, utilities, or heavy industrials, is going to take longer. So it depends industry by industry. What we're also seeing is a huge variance across geographies. So we're seeing new trade corridors emerge. India is trading a lot more with Europe and with the US. ASEAN companies with China. So we're going to see new trade flows emerge and new corridors emerge as a consequence, but companies have to become much more agile.
How quickly can we see that reframing or those new channels opening up? I mean, what I'm really asking is how quickly can that actually start to offset some of the other drags that they're seeing when, for example, China can no longer export to the US and so on?
So this year, I think you will start seeing new trade corridors being formed this year. I don't think you'll see supply chains fundamentally reshaping, but you'll see demand behavior changing this year. Supply behavior will take another year or two to happen.
And the sectors where that's most pronounced?
Tech, healthcare, and consumer. That's where we're seeing a lot of it. Services trade, no one talks about, has been exempt from tariffs. But interestingly, services trade can move a lot quicker. It's a lot more agile. So we see companies also evolving and changing their business models to introduce services components because it's much tougher to tariff a service than a good.
How much of the COVID era playbook has prepared us for this moment?
Not at all, I would say. So what COVID taught you is about blockages in supply chain and finding alternative suppliers. It didn't force you to look at new demand markets. So COVID helped you with supply management. It didn't help you with changing demand. So where do I base my production facility, whether it's closer to the consumer or closer to home? This is a completely new playbook. And which is why I think companies need to be much more agile, but also get partners to help them with that.
So that friendshoring argument that came after COVID, and even in the first Trump policy where the tariff story was happening, where if you're Hasbro, for example, and you want to sell toys in America, you build your production facilities in Mexico, that argument slowed down during the Biden administration. Are you seeing more momentum and more move from some of the folks you're speaking to?
So you look at the hard data, supply chains actually got longer rather than shorter. So instead of producing in the last 7 years, right? So instead of producing, you are moving production closer to home, but effectively it ends up being the assembly that's moving closer to home as opposed to the underlying materials.
Yeah.
So that will have to change, and I think that's where the next 5-10 years we will see new supply chains, we will see new opportunities for companies who seize that.
How does that work though exactly? If you don't, because I mean, look, not every raw material is available everywhere. So is that are we shooting for an inevitability? I'm going to say this right. That isn't even possible here.
It depends by industry. I mean, I don't think you can fundamentally reshape what the world of trade looks like, but what you can do is decouple. So companies are looking at China for China, US for US, and you can have new trade corridors emerge. But the underlying raw materials, I agree, but I think the manufacturing can move.
We talked to some of the shippers the other day. Who did we talk to? Maersk. We talked to Maersk and we talked to Hapag-Lloyd. Both were painting a really positive picture about what they've seen post, what was it, 2 weeks ago, the China Monday deal, the Monday deal that we got on China and the announcement. How big an impact has that had? Is that sustainable? What are you seeing in your data right now? Just give us a coalface experience of what's going on.
So we saw front loading before the April announcements.
Yep.
We saw a huge amount of blank sales, so cancelled shipments in the few weeks after that.
Yep.
The trade agreements mean we've seen a spike in the first few weeks of May.
Yep.
So companies are building up inventory on a really short-term basis.
So does that just delay the effect?
That delays the effect.
Right.
So it kicks the can down the road. So till we end up with, it's realistic to assume 10% is going to be the new baseline.
Yep.
And that's a scenario I think most.
So when do we get a clean number? When do we? Assuming we stability.
Your guess is as good as ours.
Okay, fair enough.
I mean, something that caught my eye as well is that this confidence story, that despite all of this disruption, businesses still have this confidence. I want to ask, what is behind that optimism? And is it overconfidence, or is this a sort of genuine story about resilience?
So what trade does is it meets a consumer demand. Consumer demand is not weakening. Whether it's in the US, arguably China, you're seeing a pickup in consumer demand, and that's what's driving business confidence. But also, I think businesses have realized there is a lot of value to expansion into new markets. UK companies have typically looked at Europe, looking at markets like India and ASEAN. So there are new growth opportunities, and the confidence has been the highest in Indian companies, companies in the Middle East. This is where we're seeing underlying demand and new trade coming in.
What are you telling your clients that you work with in terms of ensuring that possibility? If we're waiting for the actual trade developments to take place over 5-10 years' time, how do you trade that? How do you prepare for that in the interim?
Your strategic plans can no longer be linear. You have to prepare for different scenarios. So agility becomes really, really important.
How do you do that? Give us an example of the solutions you provide.
So what we do is we help you mitigate the risks with finding new buyers, expanding into a new market, finding new supply chains. So in this case, you do three things. The first is you break up your demand into your home market and markets which are core and non-core. The second is you look at where you can expand activities. And the third is you partner. So you have to form partnerships to hedge against different scenarios.
The big scenario kind of here, though, isn't that, are we heading into a world where the US consumes less? So Donald Trump the other day was talking about children buying fewer dolls. You can have, what was it, 1 or 2, as opposed to 30. This is the story that we're heading into, which is a US consumer that has got very used to cheap stuff. Yeah. And you wonder whether or not that cheap stuff is going to be there. And how do you kind of break that addiction to cheap stuff? Is it by changing the dollar narrative? Is it by tariffs? And you wonder ultimately kind of how quickly this works its way through into the system. But there is this kind of, the US has been this kind of dump consumer for the rest of the world for really a long time.
But it's a question of price sensitivity, isn't it? It's because, I mean, this week we've heard from, I'll give you the Nike example, because I'm a little obsessed with the story. They put out a conversation in their earnings or the analyst call somewhere where they said that the trainers or sneakers that were sell for about $100, they're going to go up by $5 at most, but only if they are selling at the moment for over $100. But as a consumer, I'm thinking, that doesn't make that much of a difference to me, from a $100 pair of shoes to a $105 pair of shoes. And it's that line that's unclear of where that red line is in terms of changing. Okay, well, at 105, I might not change it, but at 150, I might reconsider what I'm buying. And we haven't found that red line yet.
I mean, are companies finding that red? Because it speaks to your point when you're talking about tech, for example, and some of those sort of higher cost sectors. Are companies sort of finally finding those thresholds?
Finding demand elasticity is the biggest challenge for companies. And if consumption were to go down, that's economic slowdown. Right? So I'm not sure that's the outcome that's intended, and hopefully that's not the outcome.
Isn't that what Trump's talking about? That ultimately, when he talks about the consumer consuming less cheap stuff, and that seems to be the kind of the message, the underlying message that is coming out.
Or is it switching to different products? So,
right.
So is it either reducing consumption, which is not necessarily a good outcome for the economy, or is it switching to a different product set?
How do you read it?
And so I think it's the latter that's being expected, because switch to American-made products is obviously the expectation, and I'm not sure how possible that is for the entire suite of products that you've got.
Okay.
You mentioned that this strategy changes sector by sector. Which sector has it the hardest and which sector has it the easiest?
I think services sectors have it the easiest right now, because by definition, if you're in a tech services sector, your products travel across borders, have not been impacted by tariffs, and that's where we're seeing the most. Short-term consumer goods are probably which are going to get hit the hardest. So you have built up inventory over the short term, but consumers tend to be quite price sensitive in that space.
You wonder whether the dollar's the cheapest way of doing this. You just reduce the value of the dollar, and that makes everything more expensive in America.
Yeah, I mean, that's one of the strategies. Way. Yeah. I mean, what do you think is the thing that we're most commonly misunderstanding or missing about the China story when it comes to this whole reshaping of supply chains and tariffs?
So China supplies a little over 30% of what we eat, wear, and consume. Mm-hmm. That's unlikely to change anytime soon. I think that supply will find new homes potentially, but our reliance as a global economy on Chinese manufacturing is unlikely to change fundamentally anytime soon.
Vivek, masterclass, thank you very much indeed. Really appreciate you stopping by to update us. Vivek Ramachandran, Head of Global Trade Solutions, joining us from HSBC. Coming up, we'll turn to the United States. The White House ordering Harvard to stop international enrollments, escalating its fight with the elite US college. Details on that story next. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. 46 minutes into the equity market session. Volume is anemic. I've just checked the chart. There's not a lot going on in terms of the volume story, just to kind of put it out there in case you think that I am underplaying what we're seeing on the screen in front of you. The FTSE 100 is outperforming a little bit this morning. You are seeing that because you are seeing some of the oil majors doing relatively well this morning. Oil looks like it's finding some stability. You're also seeing some of the healthcare companies, AstraZeneca, etc., doing relatively well as well this morning, and that, like Astra's a pretty big weight on the FTSE 100, the biggest weight on the FTSE 100. It's giving that market a little bit of a lift. But this feels like a market on a Friday before a long weekend in the UK and the United States. So there are other things to talk about, Harvard being one of them.
It absolutely is. I mean, look, this is a political story. This is an economic story. This is a financial story. The Trump administration has blocked Harvard University from enrolling international students in a major escalation of its fight with elite American colleges. Now, Harvard President Emeritus Larry Summers blasted the move.
This is vicious. It is illegal. It is unwise. And it is very damaging. Why does it make any sense at all to stop 6,000 enormously talented young people who want to come to the United States to study from having that opportunity?
Larry Summers there, the Harvard President Emeritus, among a series of other roles, really blasting the move from the Trump administration. This is, of course, a scary political story in the United States, really chilling and dampening some of the international desire to get an American education, not just in Harvard, but other universities as well. This is also a financial story. Harvard is a $53 billion endowment. You lose the tuition from some of these international students. You have to dip into a pile of money that is largely wrapped up in private equity, long-dated assets, the very sectors that are already feeling pressure right now. I don't even know where to start.
Would you describe Harvard as a forced seller, I guess is the question?
Yeah.
At some point soon, it may be.
And a trendsetter, because it's not the only, this is the biggest endowment, but certainly not the only one.
There will be others who are looking. In fact, we've already seen that, right? Yale and so on, coming to market, selling debt. The others are looking at other ways. Maybe it's through private markets. But this is a whole recalibration of what's to come. And there will be this sense of, even if their hand is not forced in the way that Harvard's has been, they have to start preparing.
Is this a zero-sum game? Is this also good news for other international universities? Somebody points out this morning, Oxford and Cambridge. Are we going to see extra demand coming through for other elite universities around the world? You're already starting to see, actually, even US citizens talking about maybe looking to study internationally because of what is happening around the US universities right now and the pressure that is on them, not just with this, but with other issues as well, maybe shifting the focus to, therefore, studying elsewhere. And you do wonder, therefore, whether Imperial, Oxford, Cambridge, other European universities do better as a result of what is happening here. That could be a spillover effect.
I mean, I think when it comes to China and Asian students, you're already seeing that, actually. Yeah. You know, the last couple of years, not least just because of US-China tensions, and, of course, the way that the US presented in Chinese news, often highlighting things like issues of violence and crime and so on. We've already seen this shift away from some of those US institutions. So I think what's happening at Harvard is only going to reinforce a lot of, some of them are stereotypes, but a lot of those perceptions. Longer term, US isn't somewhere that you can actually go and build a life. That's the other concern for international students, particularly when you're thinking about coming from China. It's not just about getting the accreditation and necessarily going home immediately. They're thinking about starting their careers. And so if the US is no longer that sort of haven that it once was, it was no longer that opportunity, that's a whole mindset shift.
It's a ticket. It was a ticket. It's maybe no longer a ticket. Okay. Let's talk about we're done with this week. Next week is going to be shortened, so we're going to move on and talk a little bit about.
It's official. You've declared it.
It's 8:50 in the morning. Nothing's happening. I think we can move on. The weather outside looks fantastic. Long weekend coming up. We'll get on to the sports in just a moment, but let's talk about what is happening next week. Monday closed, UK and the United States. There's a few things happening next week. US durable goods, I think, will be interesting. FOMC minutes also will be worth paying attention to. We've got actually holidays at the back end for Europe. So that's going to be a factor you also want to fold into your thinking as well. US GDP, you get the UMich final print. Like the UMich data on its initial print is quite interesting. I'm not sure how much attention we'll pay on the final print. What's Valerie Totel going to be looking for next week?
Well, look, there's not a lot of action. There wasn't a lot of data action this week either. And I think in the lack of news, we tend to be focused on the politics coming out of Washington. But I, for one, am just kind of, shocked at how well the Treasury market has performed this week. Yes, we had yields rise, but look, we had the Moody's downgrade to deal with, and then this tax bill being passed in Congress. And take a look at 30-year yields. They're 6 basis points higher on the week? I mean, I think that's kind of incredible. We opened up at 495. Yeah. We're below 502 at the moment.
Valerie's glass is very much half full.
I love it. I love it. She's usually here warning about the deficit and like the end of the world, and this is a nice change of pace.
But look, I think this is a decent signal, right? I think for many people, the bear case for the equity market was a bond market blow-up, was a yield surge that really dented companies' profitability. And frankly, we've had plenty of catalysts, but the market hasn't had this big bond market blow-up. And I'm scratching my head thinking, when could we get that blow up? And if it doesn't come soon, we're, set for an equity market rally. I know you guys have been talking with people on the show this morning about how if the U.S. data does turn, we might not see it until the end of the summer, talking about end of July, August, maybe even September until we start to see, this air pocket people have talked about because of the tariff fight. But hey, I mean, we could easily visit all-time highs in the equity market before we hit that.
The case for the equity rally. Where should we be looking? When do you think we'll start first sort of seeing those signs?
Look, I mean, I do think there is a risk. Even today, we see a melt up in the equity market as people realize that these yields, didn't puke this week, frankly. We didn't reach cycle highs in the 30-year, and now we can start thinking about catalysts the other direction. Maybe we get the Bank of Japan paring back its QT. Maybe they're reassessing their buckets and buy long-end JGBs. Maybe you get the U.S. administration talking about relaxing bank capital rules. We've been talking again and again about this SLR reform that could possibly make it easier for U.S. banks to hold treasuries. Right now they have a risk weighting. If they reduce that risk weighting, there's another big buyer of treasuries entering the market. So, with the bull case for the bond market, that is kind of hand in hand with bull case for the equity market.
So 24 hours ago, we had this conversation around the concerns, but the same concerns still are there, even if it doesn't seem to be digestible, which is there's excess supply hitting the market. Who's going to absorb that? If there is this kind of liquidation, we were just talking about it from a Harvard, from an endowment perspective, but from foreign governments as well. Can a bond market, can Wall Street handle that? Is that still a concern 24 hours later?
So it was more of a concern, I think, when we were penciling in an economic downturn in the U.S. Because what happens when the U.S. enters a recession? Normally debt to GDP rises. There is extra government spending because of automatic stabilizers. But if the U.S. economy economy is juiced by this extra fiscal spending and we don't get that economic downturn, I'm really wondering, you know, when the next catalyst for the bond market is going to come, quite frankly. I mean, yes, we know that Treasury market is climbing in size. You know, we were talking yesterday about the size of the U.S. Treasury market. It's going to reach 30 trillion this year, likely to be added and compounded to that because of this government spending. But the market is adjusting to that quite well. I know we were talking, Guy, about maybe this is going to be the reverse. So instead of a U.S. recession we're worried about, the U.S. economy does okay, maybe even picks up, and we see the Fed hiking. Maybe that be the bond market catalyst for yields shooting higher.
Things we don't expect.
I think you two are jinxing this market. You're like nothing's happening, everything's okay.
I've got to do that.
You absolutely have to. And as a journalist, it feels like you have an obligation. Of course, we will be speaking to Scott Bessent, the U.S. Treasury Secretary, upon his return from the G7. You will not want to miss that conversation at about 4:30 p.m. UK time.
I have a theory that Valerie is in such a good mood because she went to the flash show.
That was beautiful. Always puts you in a chipper mood to smell all the roses.
Yep, absolutely. Been quite literally smelling the roses. The Chelsea flower show is on. Everybody's kind of very excited about that in London. The weekend looks great. People are still going. I think my wife's going tonight. Maybe she'll be in a great mood afterwards. We'll see. Come home with some plants, maybe. Anyway, International Africa Festival held in Germany. We're looking forward to that. The world's most boring Grand Prix, the Monaco Grand Prix, is going to be taking place as well. Beautiful, but quite dull, in my view. Premier League is going to be concluding as well. We already know what's going to be happening there. The Chelsea Flower Show. The most exciting event this weekend is the Cooper's Hill Cheese Rolling Festival.
I urge everyone to look at YouTube videos of this. I found it quite shocking when I had to look it up yesterday.
Yeah.
Rebecca, have you ever...
This is the event in Gloucestershire. Yeah, do not go to A&E anywhere near this.
If there's one thing that could ever persuade me to move back to the UK, it would be to see men chasing after a 100-mile roll of cheese down the hill. This is where we shine.
This is where the UK stands out. Yeah. The Chelsea flowers and flowers and cheese. Quite the weekend. Though I suspect Monaco is going to take the story this weekend. That wraps things up. We're kind of nearly done. I know Val actually wants to talk about the AI device that OpenAI.
Oh, yeah. I mean, come on, ChatGPT becoming a hardware device? I'm really excited. They're going to reinvent what it means to, you know, have a computer. We're going to have a Tamagotchi.
What do you say, Tamagotchi?
ChatGPT friend.
Friends.
Rebecca, it's been great to see you. Thanks for stopping by to see us. It's been an absolute pleasure. We'll look forward to seeing you next time you are in London. That wraps things up for the opening trade. Francine is not here today, so I will be taking you through the next hour. The Pulse is coming up next. This is Bloomberg.
Investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet. Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
It's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for aid as the tariff and global economy evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
The dollar retreats, Treasuries stabilize as Donald Trump's tax bill advances to the Senate despite concerns about U.S. debt. The U.S. administration bans Harvard from teaching international students in a significant escalation and warns other universities could be next. Plus, G7 finance chiefs gloss over the impact of U.S. tariffs but warn that international trade will never be the same again. It's a quiet Friday. Let's talk about what is happening in the markets. Then we'll dig into the details of what's happened this week and where we go next. Let's talk about the markets in detail. At the moment, what you're looking at is S&P futures basically calm. Look at the futures story, and you probably get an idea of what is happening here in Europe as well. Very light volumes. The US 30-year, a little bit of a bid coming back in there. We've got a euro that is bid as well, but not by much. We're up by around 0.5%, so creeping a little bit higher. And take a look at Bitcoin. What a run it has been on, rolling over a little bit today. But that has been quite the trade of this week. Quick look at the European map to give you an idea of what is happening with European equities. As I say, take a look at the AVAC function on your Bloomberg. It will tell you the volume is light heading into a long weekend in the UK and in the United States. I think people are just pausing for breath. So you're seeing a light market today. The DAX is up by around 0.5%. Deutsche Bank's gone ex-dividend, but it is a very quiet story out there. But let's dig into the details about what has happened this week and get this Friday session going.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Francine's off today, so you've got me. Welcome to The Pulse. I'm Guy Johnson, in for Fran. Let's talk about what is happening in the markets. I've already given you some of the numbers and the details. Treasury steadying a little bit. We've seen a big sell-off, actually maybe not that big a sell-off, we'll come to that in a moment, this week over concerns around what is happening with the US debt story. US stocks on track for their worst week in more than a month after a period of relative calm in financial markets. Natalia Lipakina, head of EMEA equity strategy at JP Morgan Chase Private Bank, joining me around the table. Good morning.
Good morning.
How much has actually changed this week? We've seen a US bond market that has been firmly in focus, a concern around the debt story. The US Treasury, the long end 30 years, we've seen obviously something of a sell-off. Yields have been rising. But how much has actually, in your mind, actually changed this week? Because I look at the numbers and I'm slightly scratching my head thinking, not a lot.
Exactly, not a lot. And if you think about, this is really the continuation of the story that we had for the last year or so, right? And when you see where the big moves are happening, they're actually on the long end of the curve. If you look into the equity markets, they're actually relatively stable, given the moves on the long end. And for us, this is really the story of earnings. Coming out of the earnings season, we actually had pretty good and solid earnings season. Not a lot of companies cutting guidance.
A lot of that was tech, though, wasn't it? Didn't that skew the number, as it always seems to, but didn't that skew the figure?
Potentially, but remember, everyone was very skeptical going into the earnings season about the tech. And the fact that a lot of companies actually confirmed their CapEx guidance in terms of the tech spend for this year, the market took it really well.
Do you think, therefore, we're setting the ground for actually equities to move up from here? We've been very range-bound for quite a while now, so I'd say that, a few weeks. Which way do we break out? Up or down? Are we going to break out? Up or down?
Well, we actually see high single-digit upside in the US market in the next year. So we think that the equity market is likely to make all-time highs again. And in Europe, we actually expect low double-digit returns. So overall, you will see that we remain very positive on the equity market from here, with the preference of DM, developed markets, over emerging markets.
Okay, we'll explore that latter point in just a moment, but let's explore the US versus Europe argument at the moment. I'm hearing a lot of people being very excited about Europe, but then in the same breath, they also say, we've seen this before, and I'm still a little nervous. I like the European story, I like the diversification story, but I feel like I've seen this movie before, and I've been promised in the past that Europe is going to catch up and do better, and then it didn't.
So we like both regions. We like US, we like Europe. But I think what is different in Europe right now is the improving domestic story, which we actually haven't seen in the last 5 years. You see the two parts of that improving domestic story. One is 500 billion of fiscal spending in Germany. And if you think about it, 4 trillion economy, it's a big chunk of the economy, 12% of GDP. If you compare that to COVID stimulus in the United States back in 2021, very similar stimulus on a much larger economy, the impact is not as high. And then if you look into the European countries that are increasing their self-reliance in security, those two factors is not something that we have seen in the last 5 years. So therefore we think that, well, Europe has always been cheap, but now there is this potential to unlock that valuation potential, and also the earnings is probably going to be high in 2026 and 2027.
Is it more logical for you? I'm just trying to think about the various kind of groups of investors we have. If you're a European investor, is it more logical to bring money home or invest more at home at the moment? And I ask that question because I've also got the dollar as part of my thinking too. If we get a weakening dollar, that just works against me if I'm looking to go into a US market that I think is probably going to underperform a little bit versus Europe, and then I've got the dollar to think about as well. So is there a home bias now coming in for European investors in particular?
So we just launched our mid-year outlook with the title Comfortably Uncomfortable, and one of the parts of that outlook is actually dollar diversification. And this is what we're seeing in our market as well, that a lot of people have very big overweights towards the US market. Overall, that's something, it's a story of the last 10 years or so, that, you know, the very good performance that the US market had over the last 10 years actually played a role in those big overweights. So if we're seeing a bit of a weakness in dollar going forward, there is a chance that those, you know, investments can move just a little bit to the European
But is that
market.
primarily about, is that European investors or is that US investors? Because the argument to get European investors is relatively straightforward. For US investors, dealing with that kind of home bias, that natural instinct, is much more difficult.
What we're seeing in the flow data right now is predominantly driven by European investors.
In terms, therefore, of where we go from here, as I think about a more diversified portfolio, how different does it look going forward? How different is it going to be versus what I've had over the last 15 years? And how long does it take me to get from A to B in terms of the diversification story that I'm doing? How long should, is this something I need to do quickly, or is this something that I can edge into?
It's probably, you know, the theme over the next couple of years. Because if you think about it, I don't think this is frankly just an equity story. Because if you think about equities and bonds, it's also the conversation of adding diversified assets to your portfolio. Where JP Morgan had been talking about gold, we've been talking about infrastructure, hedge funds. So something that adds a slightly different risk-return profile to your portfolio. And this is something that served us well this year, right? We're seeing, for example, gold moves, which is a completely different asset class compared to equities and bonds. So I think, in general, people are now rethinking their portfolio allocation, either geographically within their equities or by asset class, but maybe switching from 60-40 to adding a bit of private investments.
Why DM over EM? Because people are starting, I'm hearing a lot more conversations about EM now, particularly given that dollar story you just highlighted.
I would say that this is the only, we're actually positive on India. So this is one of the markets where we see good growth, you know, mid-single digit GDP, low double-digit earnings growth, benefits from supply chain diversification. So all a good story there. But we're just not very comfortable with China right now. We're not seeing...
So ex-China EM, you're much more comfortable?
Correct, correct. I think the dollar story actually helps the emerging markets, but China is what keeps us not being that positive on the emerging markets overall, because just how big China is in the emerging market index.
Okay, so how much should, if you don't have to benchmark to that, the emerging market story is still an okay one? If people are thinking about how their portfolios are going to work and diversification, EM should still be part of it.
Absolutely.
But have you got So ex-China, you've got an overweight or a neutral?
It's a neutral position for us. And if we're thinking about, the investors thinking about international markets ex-US, we're talking about European markets, we're talking about Japanese markets, and we're talking about Indian markets. So those are areas of focus for us.
Great to see you. Thanks for stopping by on a Friday. Nice to see you. And Natalia Lipekina, Head of EMEA Equity Strategy, joining us from JP Morgan Chase Private Bank. Let's turn our attention to what is happening with the political story, because obviously that's been one of the dominant themes of the week. President Trump's signature tax bill heading to the US Senate after a narrow win in the House of Representatives. The White House wants it passed quickly, but some Republicans are still pressing for changes. Our EMEA News Director, Ros Matheson, joins us around the table. How much of a headwind are we going to see coming out of the Senate? How problematic is the Senate going to be? Because it kind of goes House, Senate, then back to the House. What are we going to see?
Well, that's right. If they touch a single word of this thing, it becomes even more complicated. As you say, and we know it had a very narrow path through the House. It's a really big bill, and that's half the challenge. You have so many things attached to it and so many components, so it's bound to cause a difficulty in the Senate, because you have GOP members on the one hand that they are concerned, some of them are concerned about pushing forward very quickly on the Medicaid part. They've got one eye on the fact that it's not that far from midterm elections, and what happens if you're looking, to be ostensibly cutting Medicaid access or food stamp access for certain parts of the US population. So they're worried about that. Some senators may push on that regard. Some are pushing for even bigger spending cuts as part of this bill. They're worried about the state of the deficit. So there's that aspect of it. And there are some who are worried about, well, frankly, a whole lot of other parts of it. So what you're going to have is a lot of horse trading that's going to go on in the Senate. The question is, we saw Donald Trump really personally put himself in the middle of this bill and basically saying, if you oppose it, he was really warning Republicans about going against him. And does he use that same tactic in the Senate? And how successful is it? Because they're on the clock. They're trying to get a vote by August. They've got the debt ceiling looming potentially around August, September. So they've got to get something forward. The question is, how significantly does this bill get changed, and do the core parts of it remain?
There's some talk of even breaking it up and putting it into its component parts. We'll see whether that turns out to be the case. Let's talk about Harvard. Big move against Harvard after a series of big moves against the university. Now there's the Trump administration banning effectively as enrolling foreign students. What does the university do as a result of this?
Well, they've actually got 72 hours. They put them on the clock, and they said, if you don't hand over essentially a whole lot of information on your international students, they want Harvard to give them video footage, internal records about some of their international students. If you don't do that, we will now proceed with this action. So the question is, what does Harvard do? Do they try and go the legal route in a quick injunction in the courts to try and stop this? Do they capitulate and hand this data over? And in doing so, if you do and you stave this off, what does that do for your future either way, right? If you're saying you're going to give the government lots of information on your students, do students then say, I'm no longer going to go to Harvard? And does that set a precedent? So they've got a difficult decision to make in the next day or two about how to proceed. They haven't said what they're going to do. You'd imagine they'll probably go to the courts, as they've already done over some of the funding cuts that they're dealing with the government, $2.6 billion in funding cuts. Do they opt for that? But then what's the knock-on effect, obviously, beyond this? Not just Harvard. There's the economy around Harvard, because these students spend money. And then there's, what does it mean for the education sector in the US as a whole?
Where does this fit into the larger Trump administration push, against kind of what is happening within the universities, but also the kind of the broader domestic agenda as well?
Well, that's the thing. You say, if it starts with Harvard, where does it go? I mean, they've obviously warning universities like Columbia as well, and so does it spread out across other universities? But you can also see the actions the Trump administration is taking against institutions writ large in the US, so the legal sector, for example. So does this sort of go across a bunch of institutions in the US, this agenda, and what does it then mean for society in the US? Not just the economy, but society, for free speech and so on. And so you can see the Trump administration really starting to remake these institutions to what they're wanting them to be, and pushing them quite heavily. So again, it's the courts, it's the legal system, and it's universities, and it's law firms. And so you kind of add that up and you wonder, where is it going?
Yeah, we've certainly seen plenty of history dominated by these kinds of overlaps between the political system, the university system, the legal system. Ross, great stuff. Thank you very much indeed. Bloomberg's EMEA News Director, Rosalind Matheson. Coming up, what are we going to be talking about? Bitcoin hovering at near record highs while Ether outperforms on hopes of more clarity on regulation in the United States. We're going to delve into the crypto story next. This is Bloomberg.
up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Earnings season is here.
European earnings season in full swing. They're coming left, right, and center.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that is the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari.
All of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
$16 minutes past the hour. Welcome back. Bitcoin has slipped a little after surpassing the 111,000 level for the first time. The new high came on the same day that President Trump hosted a dinner for top holders of his own meme coin. Joining us now is Bloomberg's crypto blogger, Emily Nicole. Thank you for joining us. This week's been a bit weird in many ways for the crypto market. It's felt correlated. Now it doesn't. Like in some ways, that's how it should be. But this does feel like we've seen a bit of a shift this week.
Yeah, I mean, if you think back to how Bitcoin was behaving during all the tariff chaos, it was trading very similar to what we'd see in equities. We kind of thought the narrative that Bitcoin can be a digital version of a safe haven had gone away. That has now come back in full force. We're seeing equities behave quite poorly this morning, whereas Bitcoin is up. It has slipped a little bit, as you said, back from that record high, but it's definitely still trading higher, as are other cryptocurrencies as well.
So in terms of where we go next, like I'm beginning to hear some really big numbers. So really big numbers. But what are you hearing? Where is the optimism right now? What is the expectation?
I mean, we were just saying actually between us over on the news desk this morning that the next thing that we're looking for are those big level numbers, and there's no reason why Bitcoin couldn't get there. We're starting to think of it more as that maturing asset class that cryptocurrencies are moving towards that, especially as regulations come into fore. That's been the big driver this week, the stablecoin legislation kind of progressing in the Senate. Trump continuing to be very favorable on crypto as well, is making a lot of institutional investors very confident in the asset class. So all of that is kind of building towards Bitcoin rallying further. The ETFs as well in the US tied to Bitcoin have done very well. And so as we see assets return to those kind of funds, that means that traditional players are moving into it. Retail may also be. And so all of that kind of portrays a rosier picture than you might get elsewhere.
We're focused on Bitcoin, but there's obviously other coins out there. And there's also this story floating around now that we could see banks issuing a kind of joint coin too. Like, what are the next developments that we need to be watching out for?
Stablecoins are definitely very interesting. I mean, that's the story that you're referring to there. With the legislation potentially going to be in place in the US by August, that then gives way to regulation being on the table within the next 12 to 18 months. And that would be very positive for that industry. You know, other banks and big firms also looking to enter the space. We have legislation for stablecoins in places like Europe already, so it allows also that global harmony. And if you have dollar-pegged assets like that acting as a gateway into crypto assets like Bitcoin, that all helps with getting traditional money, you know, big money into the space that wasn't there before.
Thanks for updating us. Appreciate it. Emily Nicole joining us on what is happening in crypto. Let's stay with the technology theme, come at it from a different angle. Bloomberg has learned that OpenAI is looking at the Asia-Pacific region for future data center sites, joining a heated race to build out AI infrastructure. It follows the news that the ChatGPT maker has secured a deal for a massive data center project in Abu Dhabi.
I do think what is going on here is that the world understands that we are in a moment, that there is an imperative to getting access to this technology. The U.S. does have the innovation lead right now, and can the U.S. leverage this lead to bring our version of AI, a democratic version, to the rest of the world, and as part of that process, bring investments back to the U.S. as well?
Tom McKenzie is here to talk about this. This is a fascinating. This is about setting standards. This is about getting out there and putting your imprint on the Middle East and what is happening in Asia. Is that the correct read of what is happening here? This is a land grab, maybe the wrong way of thinking about it, a standards grab.
Standard setting is part of the rationale for this deal and why it has the blessing of the Trump administration. It is also, and also underscores just the relentless ambition of OpenAI, the relentless ambition of the UAE, and the fact that, frankly, the hand-wringing about data center build-outs was probably slightly overdone. You're talking potentially, this is what they're committed to, 5 gigawatts. We're going to get there at some point. They're going to start with 1 gigawatt, 200 megawatts are going to come online next year. 5 gigawatts will need 5 nuclear power plants, equivalent energy to power that. It's not clear where that comes from. The ambitions of the UAE, the ambitions of the US, and the ambitions of OpenAI to make sure that their hardware is leading in terms of how it's built into some of these allies of the United States and the software components as well. It isn't just OpenAI, it's NVIDIA who are partnering with this, Cisco, Oracle, and SoftBank as well. So it's all those players coming together to build out the infrastructure that clearly the UAE thinks it wants to have a front foot on. It's going to be giving subscriptions to its residents as part of this deal and embedding it in a number of different government departments as well. It's about trying to set the standard, trying to bake this in so that competitors don't come along, China, and start to take away some of the edge that the US clearly has.
Was that the risk that basically you would see Chinese companies coming in and effectively trying to do the same thing?
So David Sachs, who is the AI czar within the Trump administration, he says that is part of the rationale for this. He sees that development with Huawei. Huawei is the leading builder now of AI accelerators in China. They still have a long way to go. They still find it very difficult, if impossible, to get hold of those lithography machines, for example, from ASML in the Netherlands. There is still an innovation gap, but David Sachs is contending that that innovation gap is closing, and if the US doesn't get in there first, set the standards, bake in the infrastructure, then China, which has very close relations with the UAE and that region, will make sure that they are positioned and taking advantage of that. Obviously, there are questions about geopolitics. Obviously, there's concern that a partner like the UAE may be under pressure from Beijing. The offshoring of US technology, the most innovative US technology, to partner nations is a concern for some within the Trump administration. We know that. And G42, who they are partnering with, historically, not anymore, but historically had links to Huawei. So all of those are red flags for the China hawks within the administration. But so far, this is progressing, and now they're looking at the Asia-Pacific region as well.
This is a very big data center in a very risky part of the world. Is that something that we should be concerned about as well?
Quite possibly. You have Iran very close by. You have unresolved tension, of course, between Iran and Israel. You have the talks that are ongoing between Iran and the US, with Trump not ruling out, of course, a military attack at Israel, and reports that Israel could be looking potentially at a targeted strike on Iran's nuclear facilities. That uncertainty is all there. I think the pushback you probably get from OpenAI and their partners, this has proven to be, the UAE, a stable operating environment for a couple of decades now, and the expectation is, or at least the bet is, that will continue. But this is the biggest data center build-out outside of the US. In fact, it's the biggest one that will have ever come to fore from it. They do not have anything of this size or scale in the US. So this is huge. It's a massive commitment in terms of CapEx in a region that is volatile.
Yeah. There's a lot of power there, though, so maybe that's a factor in the thinking as well. Great stuff, Tom, as ever. Thank you very much indeed. Bloomberg's Tom McKenzie. Let's carry on the conversation around the AI space. The startup Anthropic is set to roll out 2 new versions of its Claude software, including a long-delayed update to its high-end Opus model. The firm's chief product officer, Mike Krieger, told us about some of the technical challenges around this release.
Our only, constraint for this launch was we want it to be available to, as many people as want it on the launch day itself as well. And so it'll be generally available. It'll be in Cloud.ai for our more, end users. It'll also be available in the API for usage on day one. And then as people scale up their usage, there's often, capacity and rate limit conversations that we need to have just because the models aren't really in demand. But in terms of being generally available, it's day one.
Capacity and rate limit is a massive conversation right now. For me, a big piece of news in the last week was Grok 3 going to Azure Foundry. Is there any sort of technical or contractual reason why we don't see Opus 4 or Sonnet 4 be available in other places like that, if the demand is there?
For us, a lot of it has been around focus on the chipsets that we really optimize for. And so, we've been really spending a lot of time on Trainium 2, for example, with AWS Bedrock, and on TPUs as well on Google Cloud Vertex. And so that focus on that team has been really on those 2 chipsets. Over time, I can imagine us expanding that in other places as well.
I would wager that I'm one of the few journalists you speak to that spent time tearing apart a Trainium 2 server. A lot of fun can be had. But the next evolution of that is Project Rainier, right? So just for basic fact-checking, Opus 4 was not trained with Project Rainier, but one would imagine on the inferencing side that is going to be a very critical piece of infrastructure.
Absolutely, and the way we plan to meet the customer demand for Opus and Sonnet in the coming months, a lot of that hinges on that cluster, on being able to scale up our Trainium inference, and that team has been hard at work on making sure these models work well on Trainium on launch day.
That was Anthropic's Mike Krieger in conversation with Bloomberg's Ed Ludlow. Fascinating conversation. Ed firmly embedded into that space. Let's stay with what is happening in the technology arena, though. Bloomberg has learned that Apple is looking to release smart glasses at the end of next year. Basically, this is a challenge, of course, to Meta's Ray-Bans. Sources say the glasses would have cameras, microphones, speakers, and that they would handle tasks such as phone calls, music playback, live translation, that kind of stuff. Apple has also, we understand, stopped working on a version of the Apple Watch, which has a camera, but is looking at AirPods with cameras. We need to clarify the camera bit in the AirPod, which seems completely illogical. Apparently, these are infrared cameras that are going to be basically measuring your body temperature, etc. So that's where that story is going. Up next, we're going to talk about what is happening in the European banking space. We need to talk about UniCredit. We'll do that next. This is Bloomberg.
In case you missed it on Balance of Power.
if we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Morning, welcome back. You're watching The Pulse. I'm Guy Johnson in London. Let's talk about the top stories that you need to be focusing on this morning. The dollar retreating, Treasury stabilising, Donald Trump's tax bill advancing to the Senate despite concerns about the U.S. deficits. The U.S. administration banning Harvard from teaching international students in a significant escalation. It's warning that other universities could be next. Plus, G7 finance chiefs glossing over the impact of U.S. tariffs, but warning that international trade will never be the same again. Let's talk about what is happening in the banking sector. There's a couple of stories floating around this morning that I think are worth our attention. The European Union has decided to delay the application of tougher capital requirements for banks, trading businesses. It's a one-year delay. We largely saw this one coming, and the reason we largely saw it coming is because the US can't make up its mind what it wants to do, and the Europeans definitely don't want to be first. Let's get the details now with Bloomberg's Tom Metcalf. Tom, is it as simple as that? Is this as straightforward as that? We need to wait for the Americans to make up their mind what they're going to do on the Basel rules, and then we can all largely fall in line.
Yeah, exactly. Basically, no one wants to go first, put their own banks at a disadvantage.
Yeah.
You know, the fear is the EU implements these stricter rules, US, actually softens them, eases them, and then there's a sense, how could a Deutsche Bank compete with, say, a JP Morgan
What are we talking about here? Just give us the specifics of why you would underperform.
So it's all about, the capital requirements, right?
Yeah.
So effectively the rules are saying if you're doing certain trading, we want a bit more capital to sort of ensure if there's losses, the banks can absorb them.
Yep.
And the interesting thing here is just how material would this be? But I think you had the Deutsche Bank CFO indicating something like 7.5 billion euros of risk-weighted assets would sort of come under this thing. So be relatively significant. But as you say, people were expecting this delay, which is the second time they've delayed it, just because, as you say, people are waiting to see what Washington does.
Yep.
UK is doing something similar. So I think we're probably in wait-and-see mode. Well, at least now for 27.
The Swiss have
Well, yes, the Swiss seem to be striking very strict regulatory pros, at least with UBS.
Yep.
They're in a fascinating situation with a bank that's so much bigger than their economy. But again, that is all, a multi-year process, and I don't think, that was the first round that UBS lost a few days ago.
Yep.
I suspect there's going to be a long, drawn-out discussion, shall we say.
Discussion. Let's talk about UniCredit, talking of discussions.
Yeah.
Maybe slightly less friendly discussions taking place. Basically, you've got UniCredit escalating the Banco BPM fight. It's taking Italy to court. Why?
Yeah, exactly. I think UniCredit coming out swinging. Effectively, Rome has come out and imposed certain conditions which, in UniCredit's view, effectively make the deal, untenable, or certainly much more unattractive. And so what currently happens, you've got a 30-day delay, and UniCredit are using that to effectively try and push back against those conditions. Again, more discussions, more debates, probably more fiery conversations. It just shows, there's so much bank M&A flowing around, but what hasn't changed is governments love to get involved and are very sensitive around banking deals.
Banks, it's amazing, isn't it, just how sensitive they are. Is there you talk to a lot of people about this. Is there a way through? Is there a deal to be done still here?
Well, yeah, old Chel's the master deal maker, so I think he thinks there is. I mean, but there's so many moving parts, right? BPM, the sort of target, is very anti the deal as well, and it's one of those situations that's, where you really earn your keep. Can you kind of find something that keeps Rome happy, that obviously shareholders buy into, and actually add value? And history has shown that's very, very difficult to do, but old Chel's not given up yet.
No. I suspect he's not. Tom, nice to see you. Thank you very much indeed for bringing us the story. Tom Metcalf joining us on the banking story. Let's talk about what's happening on the trade story. G7 finance ministers have pledged to address, quote, excessive imbalances in the global economy. This following 3 days of talks in Canada. The group's final communique stressed the importance of a level playing field.
When you're talking about growth policies and the spillover that this overcapacity can have to our economy and how we're going to react, this is really a step forward. And, when I say where you find common grounds, people have talked about tariffs, but definitely there will always be tension around tariffs, but there's also places where you find common ground.
Brendan Murray leads our global trade coverage and joins me around the table. My read, they glossed over the kind of the tension that exists between G7 economies at the moment on trade. Did we learn anything useful? Was there a sort of takeaway here, other than the fact that they almost don't want to talk about it because it's too sensitive?
Yeah, exactly. So this is the finance ministers and the central bankers, and so it sounds like they've just kind of delegated the nitty-gritty trade conversations to the trade ministers. So it seems like they came to a sense of, look, we've got a lot of other things going on in the world that we can focus on. Tariffs are disruptive, but let's set those aside and focus on Ukraine and the whole issue of overcapacity and imbalances. You could apply that to a lot of different things. You could apply it to the U.S. trade deficit, or you could apply it to Chinese overcapacity. So they tried to get to some place where they could smile before the cameras at the end of it all and say, look, we're united. We have some disagreements, but we found some common ground, as the Canadian official said.
Okay. Let's talk about that delegation. So we're going to have a call later on today between the Europeans and the US. The Europeans pushed a paper out the other day it felt like they were trying to push this story on a bit because the clock is ticking.
Yeah.
Give us a sort of sit rep on what is happening in these talks right now.
It feels like the U.S.-EU talks over trade are much further behind some other countries. We had the U.K. arrangement a couple of weeks ago. Some Southeast Asian countries feel like that they're on track, but the situation between Brussels and Washington looks difficult to even get things on track. Before you do a deal, you got to figure out what you're going to talk about, and they're trading these papers back and forth.
So we haven't even got that. We're not even there yet.
Exactly. I mean, they're kind of doing this dance, and they're talking past each other in a lot of ways. And in order to negotiate a trade deal, you've got to have an outline of it. You got to know what's on the table and what's off the table. And it sounds like there's more off the table right now than there is on.
Are the Europeans pushing for a deal, but the Americans are basically just kind of parking it? Because that seems to be my sense of things at the moment.
It seems that the tone from Washington is, and President Trump has said, the European Union treats us worse than China has. So we're starting from a fairly low base of cordiality between the two trading partners. But it's a huge relationship. The EU is the biggest destination for American investment, and there's a lot at stake here. But the U.S. seems to want to go after, not just put tariffs on European goods, but non-tariff barriers, the VAT tax, and there's all this stuff that's on the table. You look at the U.S. report on its grievances with the European Union. It's like 40 pages long. There's a lot of substantive issues that the U.S. wants to bring up that the European Union is saying, well, here's what we have to offer, and it's not meeting the standards that the U.S. wants for these discussions to progress.
Brendan, great stuff. Thank you very much indeed. We'll look for the update on that call a little bit later on. Brendan and the rest of the team will be bringing that to you. Okay. It's a Friday. I don't often get to talk about kind of things like this, but it's a Friday. So let's talk about flying cars. there's not much of a segue to be made there. Chinese EV maker XPeng says it's hoping to launch the world's first mass-produced flying car next year. The push by the Chinese auto companies into the flying car business comes as policies on low-altitude aerospace are increasingly loosened.
I think mobility should not be just limited to two-dimensional travel. So I think there is definitely a policy trend that's propelling the growth of the low-altitude economy, including the flying car. On the product side, we actually have our very first product that we call the land aircraft carrier, which is a modular design with a car and flying drone together in one product. We actually hope to receive final approvals by the end of this year and hope to launch to retail consumers later next year. And that will be the world's first volume-produced, I would say, flying car.
Right, good. The president of XPeng speaking exclusively to Bloomberg at the JP Morgan Global China Summit. What are we going to do next? We're going to go back to some of the stories we've just been talking about. Ukraine peace talks and another Oval Office ambush. We're going to look back at a week in politics. Elizabeth Broad from the Atlantic Council is going to be joining us very shortly. Looking forward to this conversation. This is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Consumers are starting to pull back on their spending, and business owners are starting to push off capital expenditures.
We just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates.
You have a substantial amount of uncertainty in almost every market.
The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment.
I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing.
And so you're getting back to, okay, this is a storm, but we'll get through the storm.
People used to be very U.S. exceptionalists, U.S. And we have seen some shift from U.S. to other countries since the beginning of the year.
I think we should all be very careful. There is too much debt in the system.
We have seen a de-escalation, but we still know that some tariffs need to be negotiated, that we're in a period of pause.
Some of the great guests we've been talking to at the Qatar Economic Forum in Doha this week with their views on President Trump's trade war. Let's kind of carry on that conversation, the chair of the private equity group EQT has told us that Donald Trump's policies are making the Swedish firm more attractive to investors compared with rivals based in the United States. Connie Johnson has been speaking exclusively to Bloomberg's Kriti Gupta.
It has been rather favorable for us not being based in the US and being a US firm. Because the ones we're competing with is almost exclusively the US firms right now. And they are having some headwinds out in the world for reasons caused by others than themselves. And the flip side of that is that people are looking more for managers that are not based in the US and maybe to deploy money with GPs that is not US based or US dollar denominated. So it has benefited us, especially in Asia, but I would say also in Europe to some extent.
What do you say to global investors that are looking to invest in Europe or saying, give me a reason, Connie, give me a reason that Europe will suddenly wake up and catch up to the rest of the world? Is there a reason to be optimistic here?
Well, Europe would never have been able to get organized without getting pressure from somewhere. And now we got pressure from the US, and now we are trying to get organized. So it's clearly so that the understanding of the necessity of change is there. Now we are waiting to see the actions. We see some signs, but there are so many things that needs to change to get Europe back to a position of competitiveness. And it's talked about, and everybody travels around, meets and discusses these kinds of things. But it has to be proven that we also can get into action and create the right regimes, regulations, allowance to consolidation. We need to have one common capital market. We need to have a handful of strong, big, successful European banks. Basically, we have maybe one today in Europe. And those things need to be put in place, and they need to be put in place by the politicians, unfortunately. And that's, of course, it's a bit scary, but we are hopeful that we'll get there. And we're helping them. We are participating in the dialogue around that.
Connie Johnson, the EQT chair, in conversation with Kriti yesterday, talking about kind of Europe needing to move faster, but still struggling with that conversation. The conversation has started, but action maybe a little bit less. Let's turn our attention back to the EV story, the car sector. The EV revolution has turned a once quiet part of central China into the country's lithium mining capital, where Bloomberg has found that few operators there around the city of Yishun are making a profit. It's the subject of today's Big Take, and Bloomberg's Annie Lee joins us now from Singapore to discuss this. Annie, talk to us about why China is so keen to develop this as a domestic resource and how important it is.
Right. So for lithium in specific, it is a key material that are used in today's batteries. So while China is like the dominant force in the EV industry and even metal refinery, but like when it comes to lithium, it still imports a lot from like other countries like Australia or Chile. So it has always been a strategy for China to reduce overseas reliance and to increase domestic resources. So when the energy transition take off in this city of Yichun that we went to, we see that there are a lot of companies who are going to this city to invest, to dig up these resources called lepidolite, which is a low-grade ore of lithium. But because lithium prices at the time was very high, thanks to the EV sales, it is still a very attractive resources for China and the companies, and there were also a lot of government support and push to develop it.
In terms of why it's hard to make money here, talk us through that.
Right. So fast forward to now, this is no longer like a very boom time for the lithium prices because EV sales have slowed down in terms of the growth pace, and there is also an oversupply of the battery metal. As I mentioned, this is a very low grade of resources of lepidolite in China. The processing of it requires more steps, and therefore it is more costly to make to a specific grade that would be useful for batteries, and also the processing generates more waste, and treating the waste is also expensive. So we found that actually a lot of the production right now in this Yichun city is struggling to make profits unless you really have good links or the so-called integrated supply chain with battery makers or car makers.
And in terms of the environmental cost of all of this?
Right. A few years ago, when the market was booming, there have been local reports about high level of toxicity waste found in the rivers in the city. The river that like people drink water and wash their clothes from. And because there was a flood of like people going there into the city to mine the raw material, there were also cases of like people dumping the waste at the back of the mountain. So after now, we see that there are actually more efforts coming from the local government to improve the situation with more environmental checks, and they are regularly sending teams to local factories to test the underground water to see how the waste treatment is being managed. And there are also companies there to improve their efforts build a bigger area to store the waste, to treat them properly. But that in terms also means that actually is weighing on their cost. And this is a price that we are seeing that in Beijing's ambition to achieve self-sufficiency and also to boost their new energy sector, this is a price that like the country is paying.
Annie, thanks for updating us. Great big take. Well worth the read on the Bloomberg. Annie Lee joining us out of Singapore. Honestly, check it out. It's great, the fantastic text in there. Let's talk about kind of extending that story and talk about what's happened in the geopolitical scene this week. It has been a busy, busy week. We've had President Trump's two-hour phone call with Vladimir Putin on Monday, growing condemnation, of course, of Israel's renewed offensive in Gaza, and a second Oval Office ambush, this time with the South African President, Cyril Ramaphosa. Later today, Iran and the US are going to be resuming nuclear talks in Rome. Let's pull it all together, try and find some common threads. Elizabeth Braw, Senior Fellow at the Atlantic Council, joining us around the table. Was this the week that we finally got tacit admission by Washington that Putin does not want to end the war? And if so, where does that take us?
I don't know whether it was tacit or not so tacit, okay. but there was a recognition that, yes, Putin is not that interested in ending the war because until now, we have seen him slow walk things, and he has promised or suggested to Trump that all he wants is peace. But then they did have that phone call. We should remember that Trump and Putin have both said, and Trump has said so several times, that what needs to happen for peace to be possible in Ukraine is for Putin and Trump to have a conversation. Well, they did have the conversation, and no peace materialized. And then we get the situation where now apparently the Pope has to solve this. So it was an admission that Putin is really not that interested.
So where do we go next? You've got this Lindsey Graham bill floating around in Washington, which potentially could push quite severe sanctions back into the limelight with regard to Russia. Does the White House basically step back, allow Congress effectively to do what America needs to do next, which is push further sanctions? The Europeans have been pushing for it. Is it going to be Congress rather than the White House, though, that ultimately ends up delivering those?
Well, we should remember Congress can't do sanctions alone. It has to be done in conjunction with the administration.
But who leads, I guess, is the point.
We may see more concerted efforts by Congress, but I think if there's one painful recognition that has set in Western capitals, it is that our sanctions are not what they used to be. We could sanction South Africa back in the day, Iran, similar countries, because 30, 40 years ago, we were the economic giants of the world. We could put economic pressure on countries. Now that we're doing it with Russia and have been doing for 2-3 years, we have realized that if we put put sanctions on Russia, yes, that has an effect, but not very significant, because Russia will then switch trade to other countries that are now economically very powerful. China, India, similar countries that 30, 40 years ago could not have replaced us.
So the options now exist for Russia. You bring up South Africa, you bring up Iran, so let's talk about those. Why, as a world leader, would I want to sit down in the Oval Office right now?
Yes, why would you? Don't become a world leader. Although you're important enough, important enough here in Bloomberg. But so this is another really stunning development, staggering, shocking, whatever adjective you may want to use. Until now, world leaders have been fighting, have been using every connection they could think of to get a meeting with Trump at the White House, because they know that speaking to the president is the way to getting things done. You don't use the traditional channels. But now it turns out that even if you get that meeting, it may not work out in your favor, which is what Cyril Ramaphosa discovered this week.
I thought he handled it quite well.
He did. He did.
Is there any effect of that? Kind of, what does this mean for South Africa?
Well, what it means for South Africa is that he actually looked quite good. It looked like he was taken by surprise. He was ambushed, but he handled it quite well. And what he also did quite well, I thought, was, and I think the rest of the world thought, was to bring a couple of, let's say, sidekicks or junior partners who can participate in the conversation. In his case, the two golfers, who turned out to be quite effective advocates on behalf of South Africa. So any world leader who gets an invitation should think about bringing a couple of team mates.
Yeah, golfers. The president obviously has an interest in that area. Let's talk about these Iran talks. This has been a week in which we've heard potentially Israel planning an attack. We've got talks taking place today. Which route is your current read that we're going to take? Is it going to be the military route, or can the nuclear story be resolved diplomatically? Because I'm still trying to understand what Tehran wants out of this as well, and where its stance and red lines are.
Well, it's an extraordinary development, is it not, that these talks are even being mentioned, let alone being close to coming to fruition, because one of President Trump's major complaints in his first administration was the Iran nuclear deal, which he said was the worst deal in the history of the United States, things of that kind. And one of the first things he did as president was to leave that deal, which we should remember had been painstakingly negotiated over several years by negotiators from a number of countries, including the European Union. So it was a major diplomatic effort that had resulted in the Iran nuclear deal, and then America left it. So it is surprising that there should be this effort by the United States now to get to a new deal. But I think it has to do with the fact that it is clear that we need some sort of nuclear deal, and most of the world would say the previous nuclear deal was good enough, but what Trump seems to want is his nuclear deal.
Is the Iran threat, is the Israel threat being used to push the talks? I.e., there's that option over there, or we can take this option. We can talk, because that option is not an option that anybody really wants to take. Is it by design that both are on the table in the same week almost?
In a way, but we should remember that Trump is not a man of ideologies, so he will seize whatever opportunity he has, and so that makes it so hard to predict where he will go, with what country he will speak, and this has come as a surprise to Israel, for example, which had assumed that Trump would be an ironclad supporter of Israel, and now he went to the Middle East to have talks with other countries. And that's why it makes the Iran talks so unpredictable.
Great to see you. Thanks for coming to see us. Elizabeth Braun, Senior Fellow at the Atlantic Council. Thank you very much indeed. US Treasury Secretary Scott Bessent will be speaking to Bloomberg a little bit later. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Fiscal woes, the Treasury sell-off eases as the big, beautiful bill makes its way through Capitol Hill. Pushing for more deals, the U.S. reportedly urges the EU to make unilateral tariff cuts. Presidents Trump and Ishiba hold a phone call. And the Trump administration blocks Harvard from enrolling international students while forcing current students to transfer. 3 consecutive days of losses after the big one earlier this week. We are on track for the biggest weekly loss since the Liberation Day week. Do we try to climb back after that? We're a little changed on both the S&P and NASDAQ futures this morning. Russell 2000, that outperforms after underperforming most this week. But most of the concentration, and rightly so, has been on this bond market and specifically the long end of the curve. Now, some of the biggest amounts of the pain that we've seen have eased. At one point yesterday, we were at 5.15% on your 30-year yield. We give a lot of that back, and we do more so this morning, down by 1 basis point. On the totality of the week, we are higher by just under 8 basis points. Those are your overall markets. Let's look at some of the stocks to watch. With that is Bloomberg's Joe Easton. Good morning, Joe.
Hey, morning, Danny. Take a look at Deckers Outdoors today. The stock's sliding in the pre-market. We're down around 16% for the maker of both Hoka running trainers and also UGG boots as well. I'm told the weakness is in those shiny, colourful Hoka trainers, which aren't selling as many as expected. The UGG boots, meanwhile, doing pretty well, but that stock's sliding a lot in the pre-market today. Then we're also watching uranium stocks and other nuclear power shares on a report saying Trump is going to rejuvenate the industry with some executive orders citing some defensive concerns around other countries like China. Take a look at those ones, though. Oklo up 19%, Centrus Energy 22% almost. Going to see some big moves in nuclear energy today. And then finally, Intuit, a bit of volatility in that one after the close last night. This is in the tax industry, so it's tax software. Not the most glamorous industry, but got a big unch on the screen. But take my word for it, that's going to be a big mover. Keep an eye on Intuit. As usual, All of this on the Before the Bell opening wrap, available on the terminal shortly.
Yeah, it would be fitting that a boring tax stock is having a boring movement, at least for now. But, Joe, we will keep our eye on it for any change. That is Bloomberg's Joe Easton. Thanks so much. Now, later this hour, in just a few moments, we're going to be speaking to Marvin Barth of Thematic Markets. Later in the hour, we'll also catch up with Sitara Sundar of JP Morgan Private Bank. Now, I mentioned that the concentration has been on the long end of the curve so far this week, and rightly so. Look at what it has done. At what point intraday, hitting 5.15%. But on the totality of the week, again, that's over 5 days, but if you look so far what we've done, we are just around 8 basis points, climbing despite all of the concerns. Now, Marvin Barth of Thematic Markets weighs in on what the bill could mean for the economy, because, of course, this has been concerns over the tax bill coming through D.C. He writes, quote, "The big, beautiful bill, if passed in similar form by the Senate, will further cement the unsustainability of the U.S. fiscal path, increasing the fiscal deficit to a whopping 8% of U.S. GDP in 2025 and 7.8% in 2026. Marvin Barth joins us now. He is the founder of Thematic Markets. Marvin, so wonderful to see you. And look, this is a bond market that so many people have said maybe could be the thing that reins in what's happening, but it's been an orderly sell-off. And under 10 basis points, is this the market saying that we are fine, giving Congress the green light to go ahead with this tax bill?
Well, Danny, it's a great pleasure to be back with you. I think markets are telling Congress and all of the American people that actually you are at the end of your ability to continue to run these deficits at will. This has been going on for more than a decade now. We're just putting a capper on it at this point. And it's shocking that term premia hadn't risen more. In fact, much of the rise that we've seen is really just an adjustment of the negative term premia we built up over the last decade. It's certainly still well below what we saw in the 80s and 90s. So it's not to threatening levels yet, and maybe that's why, to your point, markets are quite orderly, but it certainly is a warning shot.
But will it get to that, Marvin? Will it get to threatening levels? Or is it a bond market that's going to let Washington, D.C. get away with it?
You know, I've always had this view of the U.S. as those old Wile E. Coyote cartoons where, you know, he's running off the edge of the cliff, and only after he's well over it does he realize that it's a straight drop down. Unfortunately, I think that's going to be the situation, Danny. But before that happens, I think a lot of other countries are going to get run off the cliff. You know, whether you like it or not, the U.S. still is the anchor of the global bond market, and everybody else comes second. And we're starting to see that in markets, whether it's in Europe, where curves have also steepened very dramatically, or most dramatically in the long end of the Japanese bond market.
Marvin, I think that part is so interesting. But how do you judge what is the push and what is the pull, whether it's all coming from the U.S.? In the case of Japan, they have their own monetary woes to deal with the BOJ that's pulling back from a bond market with a lot of issuance after owning 50% of it. We learned in prior instances that the carry trade and what happens in Japanese rates has big global ramifications. Is some of that possibly going on here, too, as it relates to the U.S. bond market?
Well, there's definitely a lot of carry trades that are being unwound. You don't have this type of movement in global rates markets without some sort of existing carry trades being unwound. And we're seeing that across different markets, to exactly your point, in different parts of the curve. I think the key point here is the one that you started with, that it does continue to be very orderly, and at this point we should at least take a lot of solace in that. That won't always be the case if all of these governments continue to try and fund large fiscal deficits, which, by the way, given that everybody's talking about raising defense spending, is actually likely.
Marvin, just to the point of the big, beautiful bill we're going to get, just how stimulative do you see it being?
Well, I think this is one of the things that markets really underestimate. And in fact, I think markets have been far too pessimistic on U.S. growth anyway. Everyone hears these broad tariffs and they think this is going to be a disaster. It's going to be terrible for growth. You know, I've done the number crunching on this. It's actually not that bad. The tariffs, even if you assume full retribution and the worst of the Liberation Day tariffs, you're really only talking about subtracting about 1% from US GDP, just to give you some perspective there. What this bill does, because those tax cuts are very front-loaded in the bill, it actually adds 1.6 percentage points of GDP of tax cuts, and that has a fiscal effect that I estimate is about 2.5% in this year and next year. So this is actually a big boost to growth, even when you take account of the spending cuts that are embedded as well, which unfortunately aren't that big.
So I guess, Marvin, what I'm trying to understand is if this is a big boost to growth, but it's also flashing an amber, maybe later a red light for the bond market, is this good or bad for risk assets?
Well, that's a really good question, but I'd separate the two different effects that are going on here, right? I think the key point is absolutely, this is a tremendously bearish bill for bond markets across the whole curve, right? Because you're getting a powerful growth effect, which means that actually the Fed is unlikely to cut this year or next year. In fact, the next move might be a hike. So you have that weighing on the whole curve, but then you do have this term premia aspect at the end of the curve. That's the part that's negative for risk assets. And so that's why you're seeing these back and forth movements in stock markets.
Marvin, I just want to end on this. I want to get your thoughts on it, because I noticed this in your research that I think many of our viewers would be interested, that you do expect President Trump to push through higher tax rates for the upper income earners. Why do you think that?
Well, I think if you look at even this tax bill, it does actually push through more cuts for lower income earners. You know, you've got the main tax cuts are for tips for overtime earnings. Those are capped, by the way, for higher income earners. You have more income for seniors. And he's actually recently broached the idea of raising taxes on the highest income earners. And if you listen to Steve Bannon, who many think is the sort of intellectual architect of the whole MAGA movement, he really is talking about raising taxes on the rich a lot. This is a conversion of the Republican Party from the party of capital to the party of labor. That is what Donald Trump represents, and I think a lot of people missed that point.
Marvin, this has been a masterclass. It is always a pleasure to have you on. Please come join again soon. That is Marvin Barth of Thematic Markets. Let's now get you some other top stories that are trending on the terminal this morning. The Trump administration has ordered Harvard to stop enrolling international students. The administration says the university's leaders allowed protests to create a, quote, unsafe environment. International students must transfer or lose their student visas. The group currently makes up about 27% of the student body. Reuters reporting that Los Angeles investment firm is in discussions to buy out OnlyFans in a deal that values the site at $8 billion. OnlyFans, which soared in popularity during global COVID lockdowns, has been in talks since at least March with Forest Road Company about a transaction. Terms are unknown. Spain's government is pushing ahead with a controversial proposal to hit non-EU residents with an 100% tax when buying homes, maybe give up on buying that Spanish villa. The bill aims to promote access to housing and tackle a brewing crisis in the property market. There is an exemption for foreign business people or professional workers who live in the country. Coming up, the House passes Trump's big, beautiful bill. We'll have more on the road ahead coming up next on your Bloomberg Brief.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
To the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get it there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
That was House Speaker Mike Johnson speaking yesterday. Senate Finance Chair Mike Crapo is the Republican who will shepherd the bill through the next stage. He told reporters yesterday the House didn't go far enough on tax cuts. For more, I'm joined by Bloomberg's EMEA News Director, Rosalind Matheson. So, Ros, the self-imposed deadline of July 4th, does it look like this bill will make it there in time?
Well, possibly not. I mean, what we're hearing is maybe this will go to a vote in August. The clock is ticking either way because of the imperative around the US debt ceiling and the need to get some sort of bill through. I mean, as Donald Trump has called it, it's a big, beautiful bill. According to him, it's definitely big. And that's the challenge, is there's so many moving parts in this bill, and it narrowly got through the House, but it's going to have a complicated path in the Senate. And you can expect that Republican senators will look to change aspects of the bill, which could slow it down quite considerably. And that's all around everything, including the expedited moves around Medicaid. They're a bit worried about what that might do coming into a midterm election with voters. You've got some pushing for even bigger tax cuts, even bigger spending cuts, and a lot of complexity there. So it's the path through the Senate is very unclear, and the time around that is very unclear. But as you say, Donald Trump is pushing very hard and personally getting quite involved in trying to direct Republican senators and others to get on board with this bill very quickly, maybe August, but obviously the clock is ticking.
Well, it's going to be an incredibly busy month and a couple weeks in Washington, D.C., because it's not just the self-imposed deadline for taxes, it's also the self-imposed deadline for trade when some of these reciprocal trade tariffs will start to come up in July. Roz, where do we stand on negotiations?
Well, as you say, there's a long list of countries still to negotiate with, and we've seen obviously some overarching frameworks of understanding that have been reached, including with the UK, but that was arguably the easier stuff because the UK is a country that has a surplus with the US. Getting trade deals with places like the EU, for example, or some countries in Asia, India, Japan, is more complicated. We do know that Donald Trump spoke with the Japanese Prime Minister. That seems to be in a general conversation versus something specific around the argument around tariffs and coming in, of course, to their meeting in the G7 summit next month. But we do know the Japan trade negotiator is also on his way to Washington for meetings, and the question is, what is the path forward for Japan, and what do they take from the arrangements that have been made so far with China, the UK, and so on, and how do they go into those conversations? But realistically, a long list of countries to try and get sorted and not so much time to do so.
It does seem, Roz, that the continual thorn in the side of the Trump administration side is the EU. The FT reporting on a letter that U.S. Trade Representative Jamieson Greer is getting ready to send his trade counterpart about pushing them to make unilateral tariff reductions. Is there any sign of appetite for the EU to do something like that?
Well, we know from our own reporting the EU's taken quite a strong stance on this, and they've sent counter-proposals back yet again to the US. And what we know is they're expecting to have a phone call today between Greer and the EU trade negotiator Šefčovič. And it's in that conversation, we're expecting the US to say no, essentially, to the latest EU proposal. And so we're back to the drawing board there. I mean, the EU has made it very clear they have red lines, just the US does, and they're a much bigger economic bloc for the US to deal with than just, say, doing a deal with the UK. And the EU has been very clear that they don't want to budge on certain things, including around agriculture. And so that relationship is much more complicated, and we'll see how that call goes and what the path forward is from there. I mean, we know they're talking, but it just doesn't seem like there's a lot of progress being made.
Roz, thank you very much for that update. That is Bloomberg's Roz Matheson. Up next, we'll discuss some of the biggest winners in finance and hedge fund world. Brevin Howard gets a boost from tariff turmoil. Pershing Square snaps up Amazon stock after a better price plunge. We'll get you our latest exclusive reporting on the hedgies. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince.
Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning and what's making headlines on various outlets. First up, on the FT, leading with the Trump administration's move to bar Harvard from enrolling international students. The administration revoked the university's Student and Exchange Visitor Program certification, effective immediately. Trump has been deepening his attack on elite institutions, accusing them of promoting woke ideology and failing to tackle anti-Semitism. Next up, the Wall Street Journal has this on their front page: the biggest banks in the U.S. exploring whether to team up to issue a joint stablecoin. The intention: fend off competition from the crypto industry. Journal sources say the conversations have involved companies co-owned by JP Morgan, Bank of America, Citi, Wells Fargo, among other large commercial banks. And on the New York Times, hundreds joining an exclusive dinner with dreams of crypto fortunes in mind. Apparently, President Trump hosted a dinner last evening at his Virginia golf course. The highest paying customers of his personal cryptocurrency were there. Protesters outside were condemning the event. Now, elsewhere, some exclusive reporting from Bloomberg. Jane Street generating more than $2.3 billion in net revenue from equity derivatives last year in India, but its lucrative trading strategy has sparked a probe by regulators. Joining us now is Bloomberg's Charlie Wells. And Charlie, if I'm not mistaken, this is a strategy that there had been a lawsuit around because traders left and reportedly brought it with them to other places. Clearly, though, the strategy is still working.
That is, so to the tune of $2.3 billion in net revenue, as you mentioned, Danny. And I mean, it's interesting. The Indian stock market had been in such a dynamic place last year that it's no wonder that we're starting to learn about some of the significant earnings that even U.S. financial firms have started to take there. And options trading really have boomed since the pandemic in India. So this really is sort of starting to show an increasing focus for India, not just for U.S. firms, but for Jane Street as well, where that India revenue, or that India earnings, was responsible for 1/10 of their net revenue. So a huge boost there.
And we got to give our, while we're speaking, Charlie, our hedge funds a big old hat tip this morning, because they've come out with a lot of exclusive reporting on performance. How have some of these macro hedge funds done in what has been a very tumultuous April?
Danny, so hedge funds doing what people pay hedge funds to do, which is to make money in any environment. So we're seeing some of these firms, particularly with funds, particularly with an Asia focus, come out ahead last month. So Brevin Howard MB Macro Fund, they had a 3% in that very tumultuous return, in that very tumultuous month of April. Southern Ridge's Summit Macro Fund up 1.2%. So this is despite all the volatility that we saw, despite all the uncertainty. Now, it's tough to know exactly what they were doing right there, but it seems like a lot of right-way bets on rates, on volatility, on oil, and on gold.
We're also seeing some reporting that Bill Ackman's Pershing Square buying a new stake in Amazon. What's going on there, Charlie?
So this was, again, making the right move at the right time. So after a 31% decline in that Amazon share price, Pershing Square saying that they made a new stake in Amazon. And on this sentiment that Amazon, particularly that cloud business, could kind of withstand any weather that we're seeing. So doing that sort of thing that investors like hedge funds to do, which is to look for investments that they think could bring in money in any environment.
Charlie, thank you so much for your wonderful reporting this morning. That is Bloomberg's Charlie Wells. Now, coming up on the show, volatility abound. We've seen a 30-year yield hit above 5% and still hanging around their equities, on track for their worst week since April 2nd week, the week of reciprocal tariffs. But Sitara Sundar of JP Morgan sees opportunities in stocks ahead. Is it time to be thinking about the upside case? We're going to be catching up with Sitara next. You're watching Bloomberg Brief on this Friday morning.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Fiscal woes, the Treasury sell-off eases as the big, beautiful bill makes its way through Capitol Hill. Pushing for more deals, the U.S. reportedly urges the EU to make unilateral tariff cuts. President Trump and Prime Minister Ishiba hold a phone call. And the Trump administration blocks Harvard from enrolling international students while forcing current students to transfer. Now, just barely 3 days of losses after yesterday, we turned it around. We started the future session positive. That has sunk into losses just over the past 30 minutes. Your S&P 500 futures and NASDAQ down by about 0.2%. We are on track for the worst week for equities since Liberation Week. But the concentration has been on this bond market. Long end yields have started their recovery, and they attempt to do so further this morning, now down by 2 basis points at just above 5%. At one point, we were at 5.15% in this bond market. So certainly more easiness coming through as the big, beautiful bill passes. Part of Congress passes the Republicans, now on to the Senate. Let's get you some stocks to watch this morning. Back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we've got to start with these nuclear stocks seeing double-digit gains across this sector this morning, and it is a bit of a political story as well. Trump said to be looking to do executive orders to rejuvenate the industry in order to counter some production over in China and other countries, using a bit of a defense meaning for this. So we are seeing gains around 19% in Oklo, also Centrus Energy up 22%, set to be probably the best performing sector we'll get today. Then over in consumer, Deckers Outdoor not selling enough of those shiny coloured Hoka trainers. I've got a couple of pairs of them myself. Other trainers, sneakers are available, of course, but that one down 18% at the moment. The Ugg boots really strong, thankfully, but it is those Hoka trainers not doing so well in terms of the running market, down 18% almost for that one. Then Ross Stores potentially is going to need to cut prices even more after a weak earnings report. That's the takeout from a few analysts today. The orders, the sales at the discounter actually missing expectations. Potentially, we might see a bit of a read across in TJ Maxx, not TK Maxx as we call it over here. You might see a bit of weakness over in those ones. Ross Stores declining, Deckers declining, consumer potentially going to be a weak spot this morning, Danny.
Joe, I one time learned why it's TKX in the UK and not TJ Maxx. Apparently it was like some sort of issue with a different company already having that name. So there you go. There's your fun fact for your Friday.
Enlightened me. I've been wondering about that for years. You've finally solved it. Thank you.
There you go. My kind of half knowledge of it. I tried. Joe, thank you so much. Bloomberg's Joe Easton. Have a great weekend. All right, the pain is starting to ease in the bond market. We can see that this morning with 30-year yields down 2 basis points. So does the bull case for equity markets get stronger? Our next guest writes, while we expect equity markets to hit new highs next year, there will be volatility around the way. We will use any bouts of volatility to leg into opportunities into areas of the market that provide portfolio resilience. Joining us now is Sitar Sundar, head of alternative investment strategy at JP Morgan Private Bank. So wonderful to see you this morning, Sitar.
Nice to see you too.
So all-time highs, is it time to start thinking about the bull market case? For so long, we've been concentrating on the negative catalysts.
So I think one of the most interesting things, look, when we talk about portfolio resilience, we just released our mid-year outlook, and the tagline of it and the title of it is comfortably uncomfortable, because there's a confluence of different things that are happening right now. We need to interpret what trade policy means, what fiscal policy means, what that means for deficit, what that means for the long end of the curve. But I think sometimes, given everything that's happened and the volatility that's happened over the past several months, we forget about the positives that are out there, the deregulation agenda, the pro-business type of agenda that we likely might see. So we think over the next 12 months, the markets will make new highs and the equity markets will make new highs. And we are constructive on not just the US markets, but non-US markets as well, Europe, Japan, and that need for global diversification. But there will be, I know we talked about this last time I was on the show too, there's going to be a difference between the headline and the index level versus what's happening under the hood. Even if you look at our price targets, at least within the United States, it's mid-single digits, but we are expecting a pretty decent amount of upside in pockets of technology. Think about software, especially the enterprise software names, where you're getting recurring revenues, but many of the valuations of these really strong growth-oriented companies are still trading at multiples that are below pre-COVID levels. That growth is not yet being appreciated by the market, given everything else that's going on right now, where you're seeing that price get pulled down, we think unfairly so. And the other side of it is financial. Some of these more value-oriented areas where, if you think about deregulation, financials is going to be one of the biggest areas that are going to benefit from that.
So we're finally concentrating on what the Trump administration has been trying to say, which is deregulation and tax cuts. But in terms of fiscal stimulus, that had been much the story for U.S. exceptionalism last year, that you had this fiscal boost. Are we back to that? Do you dust off your U.S. exceptionalism, tech reigns supreme kind of trades?
So I still think that there's a need to be balanced. I do think that obviously, the U.S. exceptionalism trade was very strong at the beginning of the year. We still believe in technology. We still believe in a lot of the strong players within the United States. But I don't think that we can discount other parts of the market. We're seeing stimulus spending within Europe as well in terms of what we're seeing out of Germany. And we do believe that defense spending and a lot of the spending that we're seeing in that space are going to shore up those markets as well. So I don't know that we can say one versus the other, but it's a little bit of the rising tide is going to lift all boats, but there's still a need to be selective. And then the other thing that I will mention, because we did talk about portfolio resilience a bit, there is still a need when you think about the volatility and you think about the risks that are there. There are risks on the downside when you think about inflation and the need to hedge against that. And we're still seeing some volatility on the long end of the curve. So when we're thinking about portfolio resilience and the traditional 60-40 type of portfolio, we actually are talking to our clients a lot more about the alternatives part of their bucket. A lot of the areas like infrastructure, for example, because you get that kind of resilient income that is actually inflation protected and doesn't have as much of the duration risk when you think about the long end of the curve. So you're getting that type of resilience on the alternative side of the portfolio as well.
Is there any scenario that could bring back the long end of the curve as that useful hedge, or do you just basically write it off for the rest of the year?
I don't think you can write it off. There's always going to be a place for core fixed income. There's always going to be a place for certain types of duration. We are, focusing a little bit more on the belly of the curve. I don't know that you can write it off. But when we think about portfolios over the long run, we always want to ensure that different parts of your portfolios are pulling different levers to hedge against the multiple scenarios that are out there right now, right? We talk about, even in last earnings season, you had so many companies that were coming out talking about the different probabilities and the different scenarios that were out there and the different earnings outcomes based on those scenarios in a very similar way. When we're talking to clients about investing for the long run, we talk about probability weighting and scenario weighting their portfolios to see, based on all the confluence of factors right now, what do we think is going to be the best use of your next incremental dollar? And when we're talking about that, infrastructure, even we were talking about hedge funds a little bit earlier, the relative value and macro parts of the portfolio where you're leaning into less correlated return streams and less correlated to the public side of the market.
Well, so in the idea that you can't just buy everything, you have to be more choosy. What do you do with retailers at this moment? We got a lot of earnings. Target and Lowe's didn't look great, but you had Walmart, Home Depot, BJ Wholesale. A lot of those talked about a resilient consumer and people still buying. What is your read on consumer and consumer-related stocks right now?
We still feel okay about consumer spending. We still feel okay about the health of consumer balance sheets. We're starting at a pretty strong starting point and an elevated starting point. So we do feel like they can stomach some of the blow if we start to see tariff-related impacts feed through to increase in pricing. However, if you're asking me about what is our feeling about consumer discretionary stocks and staples and the role that plays in a portfolio, we're leaning a little bit more into the secular parts of the economy. So like tech is within that bucket, comm services to a certain extent is within that bucket too. And then when you think about the more value-oriented side, we're leaning a little bit more into where we have clarity as to what that next 12 months is going to look like in areas that are a little bit less sensitive to the tariff-oriented risks. And financials is part of that conversation, and industrials too, to an extent.
Yeah, Sitara, this has been so interesting. Really great to have you in.
Nice to have you.
Sitara Sundar of JP Morgan Private Bank, please enjoy the rest of your Friday and your weekend. Coming up, the Trump administration bans foreign students from Harvard. We're going to look at how and why and the impact next. You are watching Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get it there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
Speaker of the House, Mike Johnson, speaking after passing President Trump's landmark tax bill on to the Senate. Now, Senator Mike Crapo, chair of the Senate Finance Committee, told reporters that he is determined to expand on the tax cuts in the bill. For more, I'm joined by Bloomberg senior Washington editor Michael Shepard. So, Shep, we go to the Senate now. How does it seem like we will indeed meet the self-imposed deadline of July 4th?
Well, rather than deadline, it might be thought of better as a goal. They really would like to get this done by the symbolic date of July 4th, but that's an ambitious timeline. The Senate is not used to working with that kind of speed. And as you noted, Senator Mike Crapo would like to make some changes to this bill. He sees a higher ceiling for tax cuts in his version of the package. And he would also like to make some business breaks, including bonus depreciation and research and development incentives permanent as part of whatever discussion he has. He is setting a line that he does not want to see any changes from what the House passed to the state and local tax deduction cap, which was raised in what was passed earlier this week to $40,000. And that is something that would appeal, to, of course, to a lot of lawmakers from blue states, but you don't have nearly as many Republicans from those regions. So it's a different equation there. The deadline they really face, of course, is August, and that is when we get closer to the X date. And this bill also contains language that would raise the U.S. borrowing limit by another $4 trillion and give them a little bit of leeway when it comes to budgeting for the next few years at least. And that is when they would really have to act by past the deadline. And speaking of the bond market, there are some misgivings that were hanging over the effort to pass the bill in the House. And we'll expect to see those surface again as it moves forward in the Senate. We saw the long end of the curve getting a little dicey and tense. We saw, as you mentioned, rates rising for 30 years. And investors are concerned that there might not be enough adults in the room. As one person we had interviewed earlier in the week said, when it comes to paying attention to deficits and debt, this is expected to raise deficits annually and raise the U.S. debt burden significantly. And that is what fueled Moody's decision to pull the credit rating, AAA credit rating it had on U.S. debt.
I mean, it is pretty amazing how orderly it's been given the Moody's and the tax debate going on, Shep. But I mean, it's going to be so busy in Washington, D.C., because it's not only a July self-imposed deadline or goal for taxes, it's also trade, too. Things come due in July as well. What are those discussions currently looking like?
Well, that's right, Danny. And July 9th is the day when U.S. trading partners have to either agree to some sort of deal with the U.S. to avoid the reciprocal tariffs snapping back at higher rates. Remember, on April 9th, the president said, hey, look, we'll hit pause on those higher rates that were unveiled on April 2nd. And of course, he hit pause in part because of signals from the bond market that all those tariffs might pose an economic risk, both in terms of recession and inflation. Now, those discussions are unfolding now between a number of trading partners. Later today, the top EU trade negotiator will hold discussions with Jameson Greer by phone. This is ahead of a face-to-face meeting next month. And the U.S. is going to make its case that the EU hasn't quite done enough in these talks. It wants to see more concessions, and it would, in particular, on some non-tariff barriers that it has seen in these talks.
And next, a very busy month. Shep, thank you so much for your insight this morning. That is Bloomberg senior Washington editor Michael Shepard. Now, elsewhere in D.C., the Trump administration's fight with elite colleges has risen to an unprecedented level. The latest move, banning Harvard from enrolling international students. Harvard President Emeritus, it is a Friday morning, Larry Summers spoke to Bloomberg about the move.
This is vicious. It is illegal. It is unwise, and it is very damaging. Why does it make any sense at all to stop 6,000 enormously talented young people who want to come to the United States to study from having that opportunity.
For more, we're joined by Bloomberg Daybreak editor Mark Perrier, who joins us now. Mark, what has been the reaction to this ban on foreign students at Harvard?
The reaction has been very strong, a lot of shock and confusion among students scrambling about what to do next. The university saying that they'll fight the ban, or it's unlawful. We're still waiting to see what they'll actually do, but a lot of shock and confusion. This story has been on the front page of every major newspaper today. Harvard, loved, respected, the most famous university in the world. This escalation in this battle between Trump and the university, it's just on another level.
To that point, Mark, part of the idea of U.S. exceptionalism had also been the exceptionalism of our universities and the output of students and research at it. Does this change that?
Potentially, yes. There is a fear this will impact on the talent pipeline in the U.S. You may see students perhaps avoiding going to the U.S. For their university studies or their PhDs, and often stay in the U.S. to do research. We need to see if there is contagion here. Will this spread to other universities? The situation is developing, very fresh. There could be a pullback on this, but I think everyone is in a wait-and-see mode.
All right, Mark, thank you very much for this very fast-changing story. That is Bloomberg's Mark Perrier. Now, elsewhere, Bloomberg has learned that OpenAI is looking at the Asia-Pacific region for future data center sites. It also follows a massive deal developing with a data center in Abu Dhabi. Joining us for the latest is Bloomberg Daybreak Europe anchor Tom McKenzie. Tom, what do we know?
Yeah, Danny, of course, as you say, this follows the commitments, the announcement that OpenAI will be leading that investment in the UAE with a data center potentially up to 5 gigawatts. That's enough power, for example, to power the whole state of Minnesota. It would require 5 nuclear power stations to power data centers of that size. They've never built anything that size before. There's nothing in the US that compares. It will take time, but what it does is underscore the unrelenting ambition of OpenAI to steal a march in terms of the innovation lead and to bake in their products on the software side along with their hardware partners in the UAE, with now that look to the Asia-Pacific region as well. So they will be visiting. We know senior executives from OpenAI next week will be on the ground in countries like Japan, South Korea, India, and Australia to work on Stargate projects, the kind of thing that you've seen in the UAE, and replicate that in the Asia-Pacific region. This is about ambition for OpenAI, and it's about making sure they can continue to take advantage, frankly, of the lead that they have on innovation and make sure their software is getting used by those populations and by the governments, and that they have the hardware to support that alongside with their partners like NVIDIA, Oracle, of course, and Cisco Systems on the networking side.
Tom, also in tech headlines, we've seen the Trump administration really push Apple to build in the U.S. instead of elsewhere. It seems that there's some reporting that Apple is ready to defy Trump on that matter.
Yes, and this comes down to China, and China's part of the story in terms of some of the skepticism you get from some Trump administration officials around what is happening with OpenAI as well. China ties into that. There is some concern amongst the China hawks that there's an offshoring of US innovation and US technology to partners that could leave that exposed to China. And that takes us to what's happening with Apple. Apple's partners in India continue to invest. Reporting from the FT, Foxconn, the maker of most of the components that go into Apple's iPhones, the largest producer of iPhones themselves, is expanding $1.5 billion additional dollars in the Indian market. India already produces about 20% of the iPhones for Apple. They get about 20% from there. By the end of next year, all iPhones into your market in the US, Danny, will be coming from India. That's what we understand. This despite, as you say, Trump last week saying, look, he's had a conversation with Tim Cook. He wants Tim Cook to invest in the US markets. He wants those products to be made in the US markets. We know about the supply chain constraints and labor constraints to actually making that happen. Apple is investing about $500 billion US over the next 4 years in the US, but that will be more focused on chips. They're a long way from doing anything on iPhones in the US. So we'll see if that becomes a tension point as Apple tries, of course, to hedge its supply chains into India.
All right, Tom, thank you very much for the latest tech reporting. That is Bloomberg's Tom McKenzie. By the way, just want to bring you a breaking news item in the past few moments that Bulgaria has cleared a crucial hurdle that will allow it to join the EU, the euro adoption. It would be only the second country in the past decade to adopt the euro since the euro's formation. Again, this would be at a time when people seem to be looking at alternatives for the dollar and, of course, mean a lot for Bulgaria and ease of use and investing in that country. So again, Bulgaria getting closer to clear a major hurdle to adopting the euro. Now, coming up, we're going to wrap up your week. We'll see what's ahead. We have more Fed Speak heading into your long weekend. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up as we head through the long weekend. Congratulations, you have just almost made it. New home sales and building permits data, that comes at 10 a.m. Eastern. We're also going to get some Fed speak from Musalem, Schmid, and Cook. That happens throughout the day. The Treasury market will also be closing early at 2 p.m. Eastern ahead of the Memorial Day weekend. So, hey, if you're a bond market trader, you get an early start to your weekend. And you probably want that, considering the week we've had. I just want to show you what the long end of the curve is doing internationally, because it's not just the U.S. that has experienced pain. We've specifically also seen higher yields in Japan and the U.K. We're down across the nations, 1 basis point in the U.S. Japan down nearly 13, the U.K. by 1. For Japan, we saw the highest 30-year yield since the notes were introduced in 1999. For the U.K., the highest yields we've seen since 1998. We did hear from Michael Hartnett over Bank of America, his latest note, buy the dip in long ends of the curve in the Treasury because he does believe that Washington, D.C. is going to get it together when it comes to the deficit. We'll see whether or not that actually happens. But again, we are still above 5%, 5.02. At what point does it impact the equity market? It hasn't been, but we are on track for its worst week since April 2nd. Gold is still moving higher. Maybe that becomes a replacement in your portfolios. All right, that is it for your Bloomberg Brief on this Friday morning. Surveillance takes it from here. This is Bloomberg.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
This is probably the first budget reconciliation bill that the bond market's actually paying attention to for the last 30 years.
Increasingly, it feels like this administration is going to have to confront the problems because the bond market has lost patience.
There is just a pushback globally on the back end of the curve.
When you back up yields, you begin to change the math.
Bond markets are the ones that are giving you the yellow flag and saying, something perhaps isn't right here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into a long weekend in Washington isn't blinking.
Right now, bond yields are going up. Is the White House feeling nervous about that right now?
No, we're not at all. In fact, don't forget that bond yields are way down from January 20th and are down today now that the bill is out there and passed.
The big bad bond market beginning to find some stability as the big beautiful bill continues to make its way through Congress, leaving gold heading for its biggest weekly gain in more than a month, and equities poised for the worst week since early April.
Guess what? When I went away, the auctions mattered. That was my takeaway, that 20-year auction really gave some pause to the broader market that we felt. Look, we can ask how much of the decline in equities really stems from just how quickly they rebounded after that delay to the tariffs, but really it is clear that there is serious pressure coming from the bond market, and it is not clear what exactly can solve it and what exactly is behind it, given the fact that we've known about some of the fiscal issues, and a lot of this has been baked in.
So the Treasury Secretary, Scott Bessent, is speaking to Bloomberg a little bit later on this morning. Look out for that conversation. I imagine my best guess is he's going to highlight the global backdrop for all of this. Japanese yields this week are up as much as US yields are, and British yields, gilt yields, are up even more than US yields. There's a global story at play here that I imagine the White House, the administration, is going to lean on just a little bit more.
This is an unwind of many years of zero-rate policies at a time where you do have inflation. Inflation came in hotter than expected, the strongest going back a number of months over in Japan overnight. There is a feeling that with increased fiscal bills as well as the potential for inflation, it just seems like it's hard to see what the bid into duration is going to be. They have a harder time understanding the dollar, though, and whether the dollar weakening is really something that is by design or whether it's just simply a byproduct that is momentary, because to me, that might be the bigger question.
That's been the complicated mix throughout the whole of this week. The yields have risen, and once again, the dollar is weaker. That's the toxic mix that spooked a lot of people earlier on in April. Just to talk about the bond market this morning, yields back down, lower again through yesterday afternoon. I think this is better news. There's a lot of people making the argument that this is self-limiting, that if you look through the cycle, when you get to these levels over the last couple of years, we've struggled to sustain it. So I just wonder whether we can stabilize here and yields begin to fall back.
Well, we are seeing that right now, and if you take a look at the flows, TD Securities came out and showed that global bonds had a weekly inflow of $25 billion, led by, guess what, the United States of America, at the same time that you saw stocks experiencing outflows. Bank of America's Michael Hartnett coming out and saying that actually this is a great entry point for the 30-year bond. So at a certain point, people are leaning into it. It does become self-limiting. There is potential other ramifications from this, in particular, risk assets. How much money does it actually draw away from risk assets, not because they are less attractive, but simply because bonds are that much more attractive?
Equity futures this morning just about positive on the session so far, going into that long weekend. Before we get there, coming up this hour, we'll catch up with Sebastian Page of T. Rowe Price, with stocks on track for their worst week in over a month. Tim Baker of Deutsche Bank on why the dollar may bear the brunt of fiscal concerns, and Beata Manthi of Citi predicting European stocks will outperform the US. We begin this hour with stocks and bonds steady. Sebastian Page of T. Rowe Price writing, tails are fat on both sides. Upside and downside surprises may continue to occur more frequently than normal. Stay invested. Don't try to be a hero. Sebastian joins us now for more. Seb, good morning. Good to see you.
Good morning.
Let's just start with the bond market. We've struggled to sustain these levels at the long end. Once you get through 5%, we usually drop back down, whether it's self-limiting or it forces corrective measures down in Washington, D.C. What do you make of where we are now, and how investable is this moment?
So the moves over the last couple days are clearly related to the budget proposal. At some point, it's basic bond math, yields up, valuations down. My view is that this is not a cataclysmic event. We are running at high deficit levels, and at some point it starts to bite. But I was just listening to your intro, and you were talking about yields rising in all these other countries. And by the way, there are a bunch of other developed markets that have over 100% debt to GDP ratio. So we're back to the discussion of what is the cleanest dirty shirt.
The issue that I think a lot of people have got at the moment is the growth expectations have fallen and yields have risen. That's typically not what we associate DM developed markets with. What do you make of that tension at the moment?
Not a good, I think on your show you'll call it the toxic brew, not a good mix.
Ramo's phrase.
I like it. Not a good mix of indicators. But look, we're having our usual bulls versus bears debate on our asset allocation committee, and we end up close to neutral at the top level. We're long diversification under the hood. We do have tactical positions, but at the top level, we're quite close to neutral between stocks and bonds. What are the bulls saying? They're saying, look, earnings growth this quarter, 13% compared to the same quarter last year, and the Fed is still interested in cutting rates. So, you know, it's okay. And what are the bears saying? High valuations, and coupled with rising yields, that becomes more worrisome. slowing growth. We started the year at 54 on the PMI composite. Now we're at 51. We all know the soft data's cratered. So slowing growth and continued geopolitical uncertainty.
How much is this a matter of time frame? That in the near term, companies are going to keep investing. Companies have certain plans. They're going to keep them. They don't want to lay people off because, frankly, they were scarred by what happened during the pandemic. And they're not as susceptible to all of these macro trends. But in the long term, the bears are correct, and that there is this pressure coming, in particular from rates and potentially slower growth.
Yeah, Lisa, I'm so glad you mentioned how, the question is how sensitive is the economy, all these companies, their spending plans, to the tariffs. And the market, this is remarkable. If you go on your Bloomberg and you plot the chart of trade policy uncertainty against the S&P 500 for the last 4 weeks, the two are tracking each other like everything that matters is tariffs and the political headlines. But there's more to it. The tariffs, so goods imports subject to tariffs represent about 10% of GDP. So what about the other 90%? And, you know, what about services? 70% of spending in this country is services. So I'm not minimizing the impact of tariffs, but it's right now we've been trading like it's all there is to the economy. And that's not the case. And if you look under the hood, you can say, well, there's a reasonable case to be made for maybe, you know, 1.5%, 2% growth this year. And maybe another 3% inflation, which...
Yeah, well, I was just in Texas, and I was talking to different executives, and they were all making this point. How are we going to change on a dime? We are not going to do that. We have all of these capital expenditure plans. That said, as an investor, doesn't it look less attractive to pay those kinds of multiples when you can get 5%, even 6% in bonds? I mean, at a certain point, doesn't it just create a gravitational weight that has to do with more valuation than, say, bankruptcies or some kind of wholesale change in the corporate landscape?
Yes, the equity risk premium is compressed, and it's compressing. The more stock valuations go up, the more bond yields go up, the equity risk premium compresses. These are discussions we're having about strategic asset allocation. Investors that think long term, how much am I going to get from equities over time? Tactically, it doesn't matter as much. Look, right now I see fat tails on both sides. If you look at April, the remarkable thing is it was flat, almost flat, right? So blink and you will miss it. April 3rd and 4th, market dropped by 10.5%. That's only happened 3 times since World War II. And then this is my point about upside risk as well. April 9th, with the tariff pause, up 9.5%. That's only happened a couple times since World War II. So we're dealing with tails on both sides. That's why I say don't be a hero. That's why I like to be in the middle on risk assets right now.
There's an extra wrinkle in all of this, though. To your point, macro risk can cut both ways. What we're trying to figure out, and Lisa and I have been talking about this now for weeks, if it cuts one way, do you know what the market is going to do in response to it? And this is the issue I have with growth expectations. If growth falls back, are you convinced that bonds rally and yields fall?
There's a threshold question. I think if you have a slow, sort of slow-burning growth, kind of not a scare, but just growth coming down, that is a different situation for bonds, and it depends on what's going with the inflation prints, right? So you can have slowing growth with inflation prints surprising on the upside and no budget discipline, and then you can have stocks down, yields up, like kind of where we are now. But Jonathan, I've heard many guests say that on your show, and I agree with them. If you really get a sell-off and a real growth scare, I don't know, maybe the claims numbers just craters, and then NFPs, and that, this is a real growth scare, and the stocks go down 10, 15%. I think investors will buy the cleanest dirty shirt treasuries.
Which has to do with a growth scare, but what about the other tail? Which is that some of these trade agreements don't come to fruition. We're hearing about a whole sort of a number of different talks this morning. We have 45 more days before that reciprocal tariff pause is up. How much is that the potential fatter tail to worry about?
Oh, yes. I mean, we're in a pause. Let's just remember, right? Technically, we're in a pause. This is not off the table. Now, what do markets look for? They look for the stop getting worse moment. We often talk about that because markets anticipate. So if we believe, and I think that's why stocks have rallied in part, if we believe that we've reached a stop getting worse moment, we're leaning towards deals, and we've kind of seen how bad it could get with bonds and stocks, and maybe there is a put on the policy side. As long as, it's going to be bumpy, but as long as we reach a stop getting worse moment, then, again, you're still subject to downside tails, but you're in a better situation than you were on April 3rd and 4th.
The first week of July is going to be fascinating. Just think about a timeline. The dates at the moment. July 4th is the target date to get this tax bill signed, delivered on the president's desk. The first week of July, I think, is it July 9th?
July 9th, yes.
That's the end of the 90-day pause. The 90-day pause is up. And then you're going to find out where the tariffs are. And we were exploring this yesterday. Whether if you pass that on a more aggressive timeline, the taxes, does it embolden the president to go harder on certain trade deals with certain nations, certain trading blocs? I'm thinking of Europe at the moment. I just wonder how things wash out in the next few weeks.
Especially because they're looking for pay-fors. And you cannot forget this as we talk about the potential for lowering tariffs significantly. Well, guess what? The revenues from those tariffs are part and parcel of this bill that we have that potentially will get passed by July 4th. How do they get that passed if they don't have the revenues penciled in from some of these tariffs?
If you wanted a quiet Friday morning going into a long weekend, I'm happy to say that so far you've got it. Equity futures
really?
On the S&P, just about unchanged.
Why would you say that?
In the bond market, just about unchanged also. Maybe it stays that way, I don't know. 453 on a 10-year. On a 30-year, still just north of 5%. Sebastian Page at T. Rowe Price is going to be sticking with us. Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. The House of Representatives delivering for President Trump, passing his big, beautiful tax and spending bill. Now it's heading to the Senate. The president posting on Truth Social, quote, "This is arguably the most significant piece of legislation that will ever be signed in the history of our country. It's time for our friends in the Senate to get to work." Meanwhile, the Trump administration has barred Harvard University from enrolling international students, citing an unsafe campus environment. The move is threatening to disrupt the education of thousands of students who make up more than a quarter of the school's student body. The White House cited the school's failure to address widespread problems impacting students at the university, including anti-Semitism. And the Supreme Court granted a request from the Trump administration to fire the heads of 2 independent agencies, but quickly ruled that the Federal Reserve would not be similarly targeted. The court referred to the Fed as a uniquely structured quasi-private entity, giving clarity about the fate of Fed Chair Jay Powell's future in the role. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the big, beautiful bill is moving on.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Live from New York City, welcome to the program. Equity futures here, negative on a 3-day losing streak on the S&P 500, pulling back just a little bit. We're down by not even 0.1% on the S&P. As of the close on Thursday, set for the biggest weekly drop since Liberation Day week. That's the S&P 500. We'll see if that changes later on this afternoon. In the bond market, just want to sit on the long end of the yield curve, just for a beat. 5.02%. We were 13 basis points higher around this time yesterday. Yields coming back yesterday afternoon, down a touch this morning. We're down a single basis point. Let's call it 5.03% this morning. Under surveillance this morning, the big beautiful bill is moving on.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
So here's the latest this morning. President Trump's big, beautiful bill passing over to the Senate, where lawmakers are expected to make changes to the legislation. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, let's talk about those changes. What changes might the Senate make?
Yeah, hey, John, good morning. Well, I was on the Senate side yesterday, and the prevailing sense is that they want to make their mark on this legislation. And there's a lot of different senators, and they have a lot of different ideas, which means it's going to be the same thing in the House, really quite a balancing act going forward. There is a prevailing agreement, it appears, that they do want to make some of those temporary tax cuts permanent, and that businesses actually might get the priority here, including on those R&D incentives, the 100% bonus depreciation for factories that are made in the U.S. over the next 4 years. As Senate Majority Leader John Thune put it to reporters, he thinks permanence will create economic certainty. We're sort of seeing that argument creep into the conversation, too, when it comes to the rolling back of those IRA clean energy tax credits. Many Republicans are saying that they think that that could undercut long-term investment in their states. We're also watching closely here those changes to benefit programs. Republicans in the Senate say that they are not happy with the speeding up of those work requirements when it comes to Medicaid, not necessarily the work requirements themselves, but just how quickly it's going to be implemented. They're also unhappy that the House has frozen the Medicaid provider tax. Also watch out how the Supplemental Nutrition Assistance Program could come into this conversation too. The Senate doesn't seem happy that the House plan is going to ultimately make states cover a portion of food assistance. John, I really could keep going here. There's a lot of things in the one big beautiful bill, but it does appear that House Speaker Mike Johnson is trying to prioritize that they ultimately keep lifting that SALT cap in that final plan. But as you well know, there's not really any senators that are advocating for that lifting in the cap.
Tyler, I was looking last night at what in the one big beautiful bill the Senate was looking to actually cut in terms of expenses versus add in terms of costs. And it was hard to find that. How many hawks are there in the Senate that are going to be looking at this and saying, how do we reduce the deficit component?
Right, and we can say that Senate Majority Leader John Thune did say yesterday that the goal is still for the Senate to find about $2 trillion in spending cuts. That would be higher than the House's $1.5 trillion goal. But at the end of the day, like you're saying, it's hard to see where those cuts would come from, or perhaps they're looking at revenue raisers. We did hear Josh Hawley yesterday say that he spoke to President Trump about eliminating the carried interest loophole, but ultimately at the end of the day, how big of a savings will that actually result in remains to be seen. Some of the key senators that we are watching include Ron Johnson and Rand Paul. They've already started to sound the alarm that they will not support this legislation if there aren't more meaningful cuts, but how they get there remains to be seen.
Tyler, appreciate the update. More from Tyler in the next hour. This is still the ultimate challenge. how to please the Salt Caucus in the House and the fiscal hawks in the Senate. That's the point of tension still at the moment.
And it seems like it's a very uncomfortable circle to square. And this is the reason why it was so instrumental for President Trump to be intimately involved. And it's also the reason why the bond market's getting a little yippy, because they're not exactly seeing how this gets squared in a way that really does reduce the deficit meaningfully.
Sebastian Page at T. Rowe Price is still with us. Seb, I want to talk a little bit more about the US and then pivot to what's happening abroad internationally. I've heard a lot of investors talk about the US Treasury as if it's a credit. Do you think they're sort of overstating the problems that we've got in Washington, D.C., or do you think that's fair enough?
I don't think the U.S. Treasuries are a credit. Again, if you compare with other sovereign bond markets, you're kind of looking at probably, again, the cleanest dirty shirt. So, you know, the government has the ability to pay its debt and will continue to do so. So it's not a worry to me. Maybe that could change, but it's not a worry.
When you say others, relative to who? Let's talk internationally. What are you talking about?
So right now, by the way, internationally, we're long European stocks. But in the bond markets, we've also added to non-U.S. bonds. We're overall short treasuries. And we like non-U.S. bonds because in a lot of markets, there's a desire to lower rates probably faster than in the U.S. And, you know, we hedge the exposure. So we like that tactically. We still hold treasuries. We're just underweight. We're also long equities in Europe.
Well, just to build on that, there's this question about whether you love this on a relative basis or whether it's a currency trade, right? Whether ultimately this is going to come down to the rate differentials or whether this is something having to do more with the idea of credit and desire to be in a particular country.
Look, again, I don't think that U.S. Treasuries are a credit. I do think that there are real concerns with deficits and budget, and that is starting to be reflected by bond investors. I know you all talk often about the bond vigilantes, but I don't think it's the same thing that, for example, happened in the UK with the Liz Truss moment. I know you've talked about this on your show.
Extensively.
So it's more about diversification. Like, we don't want to have just treasuries, and we think there's an opportunity for rates to come down for some duration gains outside the U.S., so we go long.
So you talk about the equity portion, particularly in Europe, and a lot of people are saying maybe that's been overplayed, given the fact that they still have to get their act together. Yeah, yes. It's significant. It's up a lot. Yeah. And there is this feeling of whether European nations are going to come together and actually make an agreement. Do you think there's more upside?
I think there's more upside, but you're right. Like, Europe has outperformed the U.S. on the equity side by 10% year to date. So, you know, it's starting to feel rich. But, you know, give Europe a break. It's actually underperformed the U.S. by 138% over the last 10 years. It's been a value trap. Now, a lot of strategists will say there's a valuation advantage, and there is one, even if you control for the different sector composition between Europe and the U.S. And there's a reason why the U.S. has outperformed. It's actually justified by fundamentals. If you look at the return on equity of the U.S. stock market, it's consistently improved and trended up, and in Europe it's been flat. However, that differential is now flattening and trading sideways. So fundamentals are starting in terms of growth and sustainable growth to look more similar in terms of the rate of change. Then you add on top of that, what's the catalyst to unlock the valuation advantage? Well, German stimulus, easy monetary policy, and a banking sector that now can make money because we've escaped the zero-rate environment. So banking sector in Europe that's trading at 1x book value, used to be 2x book value pre-financial crisis, still an opportunity here. All that, I'm saying, with the caveat that we still like U.S. stocks for the long run. I'm not talking about the end of U.S. exceptionalism. I'm talking about a tactical overweight where the valuation advantage of Europe can continue to get unlocked over the next 6 to 12 months.
Key word is tactical. Time frame is 6 to 12 months.
Yes.
That's not a man that's betting this decade-long structural underperformance is over. Is that fair to say?
I'm not. I think the U.S. big tech companies are awesome. The way they generate cash flows, the way they protect their margins, the way they grow, the innovation. And I think that in the long run it will continue, but they're trading, this is all priced in, they're trading at high multiples.
How does the tariff story factor into what you're describing, the lack of a deal between the Europeans and the US?
Yeah, you know, the counterintuitive thing about the tariffs here is that they've actually prompted Europe to do more for themselves, including stimulus. And perhaps there's a deregulation impulse that will come out of Europe as well. So you do this, you set all these barriers, and now you hear policymakers in Europe wanting to maybe be more like the U.S.
How many times have we said this on this program? forcing the Europeans to do what's good for them.
Well, we've said that many times, and that is something that you are seeing with respect to action, and we heard that in Davos, this whole idea that maybe this was a time for the U.S. to be more like, for Europe to be more like the U.S. At the same time, there was this expectation of U.S. exceptionalism being forever. I just wonder whether that's already priced in, and how you even understand what that pricing looks like at a time where our potential structure in the short term is really changing.
We're looking for 6 weeks of gains on a stock 600 this morning as the US heads towards a week of losses. Seb, it's good to see you. Thanks for dropping by. Thank you, sir. How are the book sales doing?
They're doing well, thank you.
Do you want to do a quick plug?
The Psychology of Leadership, a book about self-improvement and leadership.
Very cool. It's sitting on my desk right now. Sebastian, thank you, sir.
Thank you.
Thanks for dropping by. Sebastian Page there of T. Rowe Price. Coming up next, we'll catch up with Tim Baker of Deutsche Bank on why the dollar may bear the brunt of fiscal concerns. As Lisa pointed out, this week, yields are higher, the dollar's weaker. Equity futures this morning just about unchanged. Live from New York City, you're watching Bloomberg TV.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
3-day losing streak on the S&P 500. No drama this morning, down by not even 0.1%. Check out the Nasdaq. No drama there either, down by not even 0.1%. Where there has been some drama, long end of the yield curve. This time yesterday, 5.15 on a 30-year bond yield. Levels we haven't seen going back to 2007. This morning, just about unchanged at 5.03%. Promising, Lisa, that some buying did come back in to the back end of the yield curve once we got to these levels.
You have the likes of Peter Scheer, Michael Hartnett coming out and saying, it looks pretty good, actually. Maybe it's time to leg in just a little bit. You have bond buying, at least according to the flows. That said, it doesn't remove some of the concerns about the fiscal sustainability of the United States and, frankly, where that buyer base is coming from, especially given the move that we've seen in the dollar.
Hot inflation in Japan as well.
Yes, exactly.
Overnight. That's in play, what's happening in Japan. The good news today is the Japanese yields are falling back. 3 hours away from the cash open. Let's get you some morning moves and cross over to Yahara Anand. Hey, Yahara.
Hi, John. We start with Ross Stores. Those shares are falling 11.6% in the pre-market. The discount retailer withdrawing guidance, saying it's off to a slow start in the first quarter, and it expects tariffs to sting. That's because over half its merchandise comes from China, but because of its very price-conscious shoppers, it says that it's going to be very careful when it comes to price hikes. Next up, we have Deckers. Those shares are plunging here, down 17.6%. The footwear company warning tariffs could add $150 million to costs this year. This is the company behind UGG and Hoka, and like Ross Stores, also pulling its guidance, blaming trade uncertainty and weakening consumer demand. For example, growth at its darling chunky Hoka shoes unit is slowing, and they also warned of potentially needing to raise prices. And finally, we are seeing nuclear stocks soaring here in the pre-market on reports that President Trump plans to sign executive orders to jumpstart the industry. Reuters says that the president is expected to declare a national emergency over U.S. reliance on uranium coming from China and Russia. So as a result, Oklo up 20%, Nano-Nuclear Energy up 17%, and Centrus Energy up 21%. John?
Yahara, thank you. More from Yahara later this hour. Not a big fan of those chunky sneakers. Like to feel balanced and grounded.
I'm shocked. I'm absolutely shocked that you don't like chunky sneakers. It's like streamlined.
Yeah, precisely.
Yeah.
But I also like to feel grounded, so that when you move, like, you feel stable. Do you know what I mean?
I feel stable in chunky sneakers.
That's extra stability, but I don't find that stable at all.
You just feel like you're on board, like walking on the moon.
On heels.
I'd like to see you try heels, let me tell you.
Let's not do that.
It's not fun.
That's an odd thing to want.
Well, no, I'm saying, people should try it before they make us wear them all the time because they're so uncomfortable. I'm just telling you that.
No one's making you do this. I'm not. Who's making you wear heels?
What if I wear chunky sneakers? Would you be okay with that?
Wear whatever you like, right?
Oh, yeah.
It's 2025.
Oh, yeah, you'd be really happy if I came in.
Standards went out the window in the pandemic.
Yeah, I'll come in at Lululemon.
So maintain your own standards at home, all right? On our radar this morning, the big, beautiful tax bill advancing to the Senate. Senate Majority Leader John Thune saying the chamber will have its own imprint on the package, with members weighing various policy changes.
Yeah, this to me is going to be a real question about how much actual work there has been together between the Senate and the House, given the fact that ultimately you have to cut somewhere. And we're not just talking about cutting taxes, we're also talking about cutting costs. And nobody wants to cut costs in things like Medicaid. So this is going to be a real question at a time where it already is pretty tenuous, exactly some of these revenue-raising possibilities.
I mentioned this earlier, just a programming note. We will catch up with the Treasury Secretary a little bit later on this morning, so look out for that on Bloomberg TV. I wanted to fit in this story as well. The Supreme Court ruling that President Trump can oust federal agency officials except at the Federal Reserve, saying it's a, quote, uniquely structured quasi-private entity. I'm not sure what you made of that just yesterday, but I imagine that brings some comfort to certain investors.
What I made of this was how much is this single-handedly responsible for the rally that we're seeing in treasuries today, given the fact that that anxiety is not necessarily hanging over about whether or not Jerome Powell can maintain his position as head of the Federal Reserve going into next year. That, to me, is one of my takeaways from that. It also highlights how much the Supreme Court is tiptoeing into this, and so much is going to end up being with the Supreme Court, and they have tried to avoid making any really substantive rulings that give a sense of exactly how much power President Trump really has.
The president has said himself now already that given the time left on Chairman Powell's term, it would be absolutely ridiculous to make that kind of move and end up with a kind of volatility in the bond market that would undermine the policies they're trying to pursue.
And then the same president, the next day, says things like, you know, can't wait till he's terminated. So at a certain point, the jawboning has continued. And this has been somebody who speaks on both sides of their mouths on any given day, depending on tempers and depending on where the bond yields are. So it's very difficult to really get that comfort unless you have the Supreme Court saying, actually, this one you don't even have.
That's the latest on the Federal Reserve. Let's talk about the trade negotiations as well. The EU trade chief is discussing trade with his US counterpart, Jameson Greer, today. The FT reporting the US is pushing the trading bloc to cut tariffs unilaterally or face 20% reciprocal duties. Joining us now on that story is Bloomberg's Brendan Murray. Brendan, welcome to the program, sir. Just frame for our audience where discussions are currently between the US and the Europeans.
Well, it seems the two sides are pretty much talking past each other. The administration has said that it's making progress in talks with countries like India and South Korea and Japan, but the talks between Washington and Brussels don't look like they're going anywhere fast.